Hello guys, how are you? How are you? How are you? Welcome to the SBR marathon for June 2026 examinations. I hope you can see the audio and the video is clear to all of you. The audio and video is clear to all of you. Can you please confirm the chat box, guys? Come on, everyone. Okay. Let us start the session, guys. Now, first of all, few details about the session. Okay. So this session, students are asking what will be the duration of this session. So duration will be somewhere in the range of, you can say, around 7 to 8 or might be 9 hours. Okay. But the whole agenda is to complete the revision fully, and then only we'll wrap up this class. Okay. So are you with me in this? Tell me, come on, guys. Are you with me in this? Come on, guys, in the chat box, everyone. Come on, guys. Are you with me in this? Everyone. So all of you at once. How is the Joes, everyone? Come on, guys. Tell me, how's the Joes? How's the Joes? Tell me, hi, sir. So on that note, we'll start the marathon session. Okay. Now the students are asking, can the FR guys see it? Yes, FR guys can also see it. That's completely fine. Okay. Now coming to the question, in this session, what exactly we will be doing? So in this session, I will be what I've done is, in this session, if I have to show it to you, just give me a minute, please. Okay. Now. Okay, so in this session, what I have done is I have made the notes already for you guys. Okay, so now be it non-current assets, be it or whatever, wherever it is required, I have taken up the example, and this example I'll not be dictating with you. I'll be solving these examples with you in the class here itself. Okay, now examples, important concepts, whatever is required for the exam, I will be discussing each and everything. Whatever will be required for your examinations, I'll be discussing each and everything here. Okay, now see here, all the notes are ready with me. All the notes, I'll just show it to you. So examples are ready, rest everything I'll be writing here so that you understand, and you understand the concept and able to retain it as well. Okay, now before we start the session, additionally, you guys are already stuck up on something called as IFRS 18, right? So what I have done is I have made the notes for IFRS 18 for you guys, and we will be discussing IFRS 18 as well in this class. I'll just show it to you guys. Hold on a minute, please, and don't worry about these notes. I will be sharing these notes with you guys after the session ends. Okay, so this is about IFRS 18. See IFRS 18 here. Now IFRS 18 statement of financial performance, everything is here. The changes in P&L, right? Now students also struggle in other topics. So basically what I have done is all the complex, important, relevant topics for the exams, I have brought that here. Okay, and I believe it will definitely be of great help for your examinations. Okay, now, but before we start, I need all of you to hit the like button right now. And then we'll start the session. Come on, guys, tell me. Hit the like button right now. Is a video lagging for all of you? Just hold on a minute. It should not be the case ideally, but let me just check. वीडियो लैग हो रही। I think everything will be fine now. I think everything will be fine now. अरे माइक इज ऑन बाबा, प्लीज चेक नाउ. Now it's okay ना. हाँ ठीक है, डन है, चलो ठीक है. So let us start the session. We will start with non-current assets and we will study smartly, not hard work. We will study smartly now. Okay, चलो. Come on guys, everyone, please tell me. Video clear? Audio clear now? Audio video clear now? Just give me a thumbs up now. Just give me thumbs up. Audio video clear to everyone now? Chalo, now let us start the session. Without wasting even a single second now, let us now start the session. Okay, so first chapter that we have to study is non-current assets. Okay, now for non-current assets, we will study, understand first of all, under non-current assets, we have three assets, right? We have three type of assets, that is property, plant and equipment, investment property and intangible assets. Okay, now what is the meaning of property, plant, equipment? Okay, so we'll study comparatively what is the definition, what is the initial treatment, what is the subsequent treatment, difference of cost model, revaluation model, treatment of revaluation gain or loss, treatment of revaluation surplus, depreciation or amortization, derecognition and the topics. Okay, we'll study each and everything. Now tell me guys, come on, what is the meaning of property, plant and equipment? What is the meaning of property, plant and equipment? So let's property, plant and equipment are tangible assets, held for, they are held for any of these three purpose. First is production or supply of goods or services. The next is admin purpose. And the next is rental to others. But now can you please tell me guys, when I say rental to others, if I give property on rental, is it still a property, plant, equipment? No. So if I give a property, like for example land or a building or both or a part thereof, okay, if I give land or building on rental, it is not a property, plant and equipment, rather it becomes an investment property. So right here in the bracket, except property. Okay, now why? Because now if you see here, because if a property, meaning thereby land, or building or a part or both, if they are given on rental or if they are held for capital appreciation or both, it is called as investment property. It is called as investment property. Okay, then what is intangible asset? What are intangible assets? So please understand, for intangible assets are non-monetary assets, non-monetary assets without any physical substance. They don't have any physical substance, and they are identifiable. They are identifiable. Can you please tell me the meaning of identifiable? Can you please tell me the meaning of identifiable? Identifiable means it is separable. It is separable, or it arises from a legal or contractual rights. Okay, sir, can you give an example? Yes, license. License to operate. License to operate. It is identifiable. It is identifiable. Okay, now then the entity has the control over it. The entity has a control over it, and the entity will receive the benefits from these. If these three conditions, all of these three conditions are satisfied, plus it is a non-monetary without any physical substance, it becomes a intangible asset. It becomes an intangible asset. Is that clear to all of you? Come on, guys. Okay, chalo. Now, initial treatment. Initial treatment. Tell me, what will be the initial treatment of these assets? So, initial treatment will be at cost. For all of them, initially they are always recognized at cost only and no other data. Okay, only cost. Can you please tell me what is the meaning of cost? Purchase price plus non-refundable taxes minus trade discounts or rebates. But if we have received any cash discount, that will go to P&L. Okay, now what else? Any other directly attributable costs incurred to bring the asset in the intended location and condition is also capitalized to the cost of the asset. Okay, then what else? Present value of the decommissioning, removal or restoration cost. Further, if these assets qualify to be a qualifying asset under standard of IAS 23 borrowing cost, then the borrowing cost is also capitalized to the cost of this asset. Okay, then the borrowing cost is also capitalized to the cost of the asset. Okay, now subsequently, how do we measure property, plant, equipment? Tell me. Subsequently, we measure under cost model or we measure under revaluation model. Either cost model or revaluation model. But how do we measure investment property subsequently? Subsequently, investment property is measured under cost model or under fair value model. Cost model or fair value model. Now, how do we measure intangible assets? Again, I'll write here same as property, plant, equipment. Same as property, plant and equipment. But there is one caveat here. Okay, please understand, guys. Please understand. The choice of cost model or revaluation model is done on the basis of class of assets. For PPE also and for intangible assets also. But for investment property, it is said that all investment property are one class. It means either all investment property will be at cost model or at fair value model. Okay. The entire investment property will be under cost model or under fair value model. Okay, chalo, done. Now, one more point. For intangible asset, please understand, for intangible asset, revaluation model can be adopted only if active market exists. Only if active market exists for that asset. If active market doesn't exist, then we cannot measure it under cost revaluation model. Sir, can you give an example? Yes, brand name. It is an intangible asset, but active market doesn't exist. Hence, we cannot value brand name at revaluation model. Okay. Now, one more point. I'm highlighting this in red. It is an important point. I'm highlighting it in red. Okay. Now, one more point. Let's suppose for an intangible asset, for a class of intangible asset which follows revaluation model, for a class of intangible asset which follows revaluation model, tell me what will happen. All the assets in that class will be under revaluation model. Tell me yes or no. If there is a class of asset, which follows revaluation model, it means all the assets in that class will be under revaluation model. Okay. Now the standard says that if there is an intangible asset in that class for which active market does not exist, then measure that intangible asset at cost model. It means what? The entire asset, the entire class of asset is measured at revaluation model, but only that one asset is under cost model. Is that point clear, everyone? Come on, guys, tell me. Is these 2 points clear to everyone? These 2 points clear to everyone? Come on, guys, tell me. Okay, chalo. Under cost model, how do we measure under cost model? So under cost model, it is we take the original cost of the asset. Minus accumulated depreciation. Okay. Now here also same thing. Here also same thing. I'll write here same. Now revaluation model. How do we measure property, plant and equipment under revaluation model? Okay, under revaluation model. So please try to understand. Under revaluation model, first of all, frequency. When do we have to revalue? Okay, when the carrying amount of the asset differs materially from its fair value, then we have to do the revaluation. Generally once in 3 to 5 years. This is the frequency of revaluation. Okay. Now, but for investment property, if we opt for fair value model, okay, it will be done, the fair valuation will be done annually. Okay. Now, but one caveat here, please understand, if the investment property is under fair value model, no depreciation will be charged. Highlight in red. But if the property, plant and equipment is under revaluation model, depreciation will be charged. Again highlighting it in red. Now, what about intangible asset? I will write here same as PPE, property, plant, equipment, same. Okay. Now, what is the treatment of revaluation gain or loss? What is the treatment of revaluation gain or loss? Now, if it is a property, plant and equipment, and you get revaluation gain, you will record that in other comprehensive income. If you get revaluation loss, you adjust from other comprehensive income to the extent there is a balance to the extent there is a balance in revaluation reserve. Okay, now any excess loss is recognized in P and L. Now tell me, do you want to go little bit into the depth of this topic? I believe we should go into the depth. of this topic. Okay, so now from how to go into the depth, let's come here. I have got the example here. See, year 1 we got a revaluation gain of 20. So what will we do? We will record this in other comprehensive income 20, and we will accumulate this in revaluation reserve. Now what is this revaluation reserve? Revaluation reserve is a part of other equity in SOFP. Okay, and here it will come as 20. We will accumulate in revaluation reserve. Okay, now what will happen in the next year? Okay, next year again revaluation gain of 30. So we'll record that in other comprehensive income, and in revaluation reserve the balance will become, tell me how much? What will be the balance in revaluation reserve at the end of second year? What will be the balance of revaluation reserve at the end of second year? What will be the balance? Come on guys. 50. Chalo. Third year OCI we will record 50. Okay, and what will be the balance of revaluation reserve? 50 plus 50, 100. Okay, now chalo fourth year. Oh, fourth year is a loss. Please see guys here, fourth year is a loss. So what will we do? We will adjust this revaluation loss with other comprehensive income to the extent there is a balance in revaluation reserve. What is the balance in revaluation reserve? 100. Oh, there is a balance. So we'll adjust it from other comprehensive income 80 negative. And what will be the balance of revaluation reserve? 100 minus 80, remaining is 20. Okay, now let me highlight this. Next year. Now again revaluation loss of 30. What is the balance in revaluation reserve? 20. Okay, so what will we do? In OCI I will be able to record only 20. The rest 10 will go where? The rest 10 will go where? In P and L. The rest 10 will go where? P and L. And revaluation reserve will become how much? Revaluation reserve will become how much? Nil. Done. Is that clear everyone? Come on guys, tell me. Is that clear everyone? So are we just running through the theory? No. We are studying the theory concepts. And we are applying those also, so that we strengthen our knowledge. From an exam perspective, we are strengthening our knowledge, and we'll do everything required for the exams. Okay, just be with me. Just have the patience to sit with me for the next 7 to 8 hours. Just have the patience to sit with me for the next 7 to 8 hours, and I promise I will be helping with you with the revision of entire SBR paper. Okay, need not worry. And also I will share these notes with you guys so that you can also revise it on your own. Okay, and if you are watching this session and not liking it, it's very bad. I need all of you to hit the like button right now. Okay, and yes, I promise in the throughout the session I will be helping you with the songs also. I'll keep you motivated throughout the session. I will keep you motivated. I will not be a boring faculty. I will be a friend. I will be a mentor. Okay, chalo. Now, moving on to next topic. But tell me, if the entity has investment property under fair value model, then the fair value gain or loss is recognized in P and L. Whether it is a gain or a loss doesn't matter. Both will go to P and L. Okay, now What about intangible asset? Same as PPE, same as PPE. Okay, but guys, please keep in mind, no depreciation, no depreciation, no depreciation. Please keep in mind, okay? Please keep this in mind. Now, treatment of revaluation surplus. Treatment of revaluation surplus. Please understand what is the treatment of revaluation surplus. Okay, now understand. Revaluation surplus is to be transferred to retained earnings. Is to be transferred to retained earnings. Now, how or when? When? Option number one. Option number one is at derecognition of PPE. Okay, or option number two is annually over the remaining life of asset. Annually over the remaining life of the asset. Now in the exam, which option will you opt for? If the question is silent, you will go with this option. If the question is silent, you will go with this option. But if the question specifically mentions annual transfer, okay, only if question specifically mentions to follow option 2, then only follow option 2. Otherwise you have to follow by default option 1 only. Is that clear, everyone? Okay, now under investment property, do we have any revaluation surplus? No, not applicable. Not applicable. What about intangible asset? Same as PPE. Same as PPE. Depreciation or amortization? Depreciation or amortization. So please write here, depreciation will be charged. Depreciation will be charged irrespective of whether the asset is under cost model or fair value model. Irrespective of it. Okay, now how will you compute depreciation? So depreciation will be equals to original cost minus residual value. Original cost minus residual value divided by useful life of the asset. Divided by useful life of the asset. Okay, depreciation can be computed using a straight line method, written down value method. Okay, it can be computed using multiple methods which can be given in the question and which I believe you already know. Okay, now here under investment property, if the investment property is under cost model, okay, then same as PPE. But if investment property is under a fair value model, then no depreciation. I believe it is clear to all of you. Okay, now what about intangible asset? I will write only one thing, same as PP. Please understand, the entire measurement of intangible asset is more or less same as property, plant and equipment. The only difference in the accounting of intangible asset is this one, the identification of active market. The only difference in the accounting of intangible asset. Okay, now derecognition. How do you derecognize the intangible assets or property, plant, equipment or investment property? How do you derecognize? Okay, so basically at the time of derecognition, you say you derecognize at carrying amount, recognize sale proceeds, difference is recognized in P and L. Now, as per IFRS 18, you are also required to categorize this income. You are also required to categorize. Okay. So for this, we will say it is under operating category. Okay. Same here. Same. Okay. Now, tell me. So we have studied the comparative analysis of property, plant, equipment, investment property and intangible assets. I believe it is very much clear to all of you. Can you please confirm, guys? Can you please confirm in the chat box, all of you? Can you please confirm in the chat box, all of you guys? Okay, now come here. Apart from these, we are also required to study few additional topics as well. Okay, now what are the few additional topics? For property, plant, equipment, I will help you understand what is the treatment of exchange of assets. What is the treatment if we have acquired the asset under exchange? Then under intangible assets, you have to study about self-generated intangible assets. You have to study about research and development costs. You have to study about research and development costs. Okay, now this is under intangible asset. Under investment property, we have to study a topic called as transfers to or from investment property. So we have to study, apart from what we have studied so far, we are also required to study 1, 2, 3 and 4. These 4 topics we have to study again. Okay, chalo. But before, okay, let us study this and then we'll come on to this example. Exchange of assets. Okay, now what is the meaning of exchange? Okay, now one student asking about investment property. Let me answer that part. Okay, under investment property, this fair value gain or loss will go under investing category. Okay. Chalo. Exchange of assets. What is the meaning of exchange? Please see here. You had this mobile phone. I had this calculator. Okay. Let's suppose we will exchange something different. We'll exchange something different. Okay. Yes. See. 2 things. Mobile phone and this smart AI based mobile phone. Okay. Now, so I exchanged this for this. This is called as exchange of assets. Okay. Now, how to account for in case of exchange of assets? So understand, asset received, always the principal has been asset received is recognized at cost. Cost means what? What we gave. Cost means what? Whatever we gave is our cost. Whatever we give is our cost. Now tell me what exactly we are giving. The asset. Okay, that is asset given. The fair value. Fair value of asset given is the cost. Okay, so whenever we exchange the assets, we record the asset received. Record the asset that we have received at the fair value of asset given up. Okay. Now, one more thing. If fair value of asset given up is not available, then at fair value of asset received. Again, if both fair values are not available, then at carrying amount of asset given up. Today, why is this happening here? Video lag. For me, the internet connection is showing fantastic. This network issues. Is it okay now? Can you please check, guys? Oh. I believe it is okay now. Can you please confirm, guys, if it is okay now? Can you please confirm if it is okay now? Okay. Chalo. Now, one more thing, exchange of assets, you have understood, guys. I request, see, from my end, it is showing the network is good, okay, but it's happening. So, I am helpless here. I can't do anything for this, okay. But yes, I request you guys, please try to adjust whatever is happening. It's something beyond my control. Also, I can't do anything for that, okay. Just watch it properly, okay, to the extent you are able to manage. Please do it off, okay. Chalo. Now, so whenever we exchange the assets, we record the asset received at the fair value of asset given up. But there is an exception to this general rule. Okay, there is an exception. There is an exception to this general rule. The exception is in IFRS 2 share based payments. The exception is written in IFRS to share based payments. Guys, please understand, the examiner has tested this part. So please try to understand and link the standards. Now, standard says that if you have exchanged, okay, and obtained asset and paid by way of equity shares of own entity, means I have purchased asset, and in return I have not given cash, I have not given any other asset, I have given something called as equity shares, okay. Then in that case, what I will be doing here is, okay, record the asset received at fair value of asset received. This is the exception. This is the exception to the general rule. Okay, so please understand this. I believe it is clear. Now, moving on to the next topic. Okay, now further, anything else here? No. Yes, coming on to this topic of provision for decommissioning. Okay, chalo. Just give me a minute. Now, this is a very important part. Just a minute. Okay, chalo. Today, actually, there is something wrong with the network, I believe. Now, Example on provision for decommissioning. So what happens in this question? See, understand, I believe all of you know one point, that whenever there is a provision for decommissioning, we capitalize that to the cost of asset. But there is one misunderstanding that all the students have, which I want to clarify right now. Okay, please understand, the decommissioning thing, the decommissioning costs can arise due to two reasons. It can arise due to two reasons. Okay, now one is installation of the asset. One is installation of the asset, meaning thereby just because you have installed this asset, the obligation arises. Okay, second is use of the asset. So now standard says that if it arises because of installation of the asset, then you capitalize present value to the cost of the asset. Okay, but if this decommissioning cost obligation arises because you have used the asset, okay, then you expense of the provision in the year in which it is used. You expense it off. Now read this question. It says on 1st April 20x1, Vijay Limited commenced the extraction of crude oil. The cost of oil rig to extract the oil was $50 million with a life of 10 years. At the end of the extraction, Vijay Limited intends to make good the damage the extraction has caused to the seabed. Now please understand, the cost of this will be a fixed amount of 20 million to decommission the oil rig. See, just because I have installed the asset, I will have to decommission it, right? So this cost of 20 million, this obligation of 20 million arises because we have installed the asset. Okay, now this variable amount of 0.02 million dollar per barrel is arising because we are extracting the oil. As and when we extract the oil, this obligation arises. So understand, for this 20 million, the journal entry will be asset account debit to provision for DRRC. And what is the amount? 20, because it is already at present value. 20. Now, coming to use is $0.02 per barrel. How many barrels we have extracted? 150 million barrels of oil. 150 million barrels of oil. So what is the amount? 150 multiplied by 0.02, it is equals to 30 or 3, sorry, not 33. Okay, so entry will be here. Now the entry will be not asset, it will be expense. P&L. It will be P&L. Which category? Operating category. Is that clear? Is it clear, everyone? Okay, chalo. Done. So with this example, we are done with this one. Now moving on to the next topic, that is transfers to and from investment property. Okay, so for all the topics of investment property we have already studied. The only topic remaining is transfers to and from investment property. So here I will take 4 cases. Particularly. I believe the video is not lagging now. Case A. If it is transferred from cost to cost, if it is transferred from cost to cost, meaning thereby IP at cost to PPE at cost, or PPE at cost to IP at cost, to or from both time, both the areas, before and after there is cost. It is at cost. It is at cost. Okay. Then what will happen? Please understand. Okay. Transfer at cost, transfer at carrying amount on date of transfer, on date of transfer. Okay. Now, on date of transfer, will there be any revaluation gain loss? No revaluation gain or loss. Okay, done. So only there will be a name change, right? Done. The next case is case B. If you transfer from cost to fair value, so transfer at fair value on date of transfer. On date of transfer, revaluation gain or loss will arise, but this will be accounted for as per old classification. As per old classification, meaning thereby if you transfer from PPE to IP, this will be recognized in revaluation gain, will be recognized in other comprehensive income. But if it is transferred from IP to PPE, this revaluation gain will be recognized in P and L. Okay. Now, case C. Transfer from fair value model to cost model. Transfer from fair value model to cost model. Okay. Then again we transfer at fair value on date of transfer, and fair value on date of transfer becomes cost, becomes the cost. Okay. Now, on date of transfer, any revaluation gain or loss that arises will be accounted as per old classification again. Okay. Now, and the last case, fair value to fair value, fair value model to fair value model, transfer at fair value on date of transfer. Okay. Now, on date of transfer, any revaluation gain or loss that arises would be accounted as per old classification. Okay. Now, if I have to summarize it again, cost to cost, and case B is any others. This is what I can say. Simple. Let's keep it as simple as that. If it is cost to cost, transfer at carrying amount. Rest in all cases, transfer at fair value. Whatever revaluation, fair value gain or loss that arises on date of transfer, transfer to OCI as per the old classification, or transfer to P&L as per the old classification. That's all. Simple as it is. No difference at all. I believe it is very much clear to all of you. Okay. Now, but comes the question. My first question is, when do we have to do the transfer accounting? When there is a change of use, plus there is an evidence supporting change of use. I believe it is clear. Okay. Guys, tell me one thing, just tell me one thing on the basis of which I'll move further. Is the video lag that extreme that you are not able to understand? If it is the case, I will end this session now and I'll reschedule it some other time. Is it extreme? Is there an extreme lag? If yes, then write extreme lag. If yes, then write extreme lag. If it cannot be managed, then I will discontinue now and I will reschedule it off. but again and again seeing the message of video lag, even I can't help this thing. So if it is something which is beyond my control as well, okay, if it could have been managed, I would have already done it off. Okay, so it is distracting me as well, guys. Okay, so let's focus on studies. There might be a challenge which is something beyond my control as well. So I request all of you to focus on the studies. Okay, I request all of you to focus on the studies. For the students who feel it is extreme, you can quit. You can watch the recording later on. Okay, let us continue for at least half an hour more, and then we'll reassess if it can be managed or it cannot be managed. Okay. Chalo. Self-generated intangible assets. Now, what is the meaning of self-generated intangible assets? Okay, now please understand, self-generated intangible assets are intangible assets on which entity has not made any extra effort to develop them. It got generated on its own. Okay, those are called as self-generated intangible assets. Okay, chalo. Now, self-generated examples. Brand name, okay, customer lists, etc. Okay, now it is not recognized in financial statements. It is not recognized in financial statements, but there is an exception. And what is the exception? What is the exception? So basically the exception here is in case of group accounting, if an entity if subsidiary has any self-generated intangible assets, then it is recognized in a group financial statements at its fair value on date of acquisition. Okay, chalo, done. Now what's next? Research and development costs. So research and development cost, basically we have to divide into three phases. One is research phase, another is development phase, and third is developed phase. So first of all, understand the accounting treatment of each of these. Under research phase, we expense of it to P&L. Under development phase, we capitalize, but do we amortize it? No amortization. Capitalize to cost of intangible asset. Okay, but no amortization. Okay, but since we are not amortizing it, we have to test it for impairment annually. Okay, now what happens in a developed phase? So it is under developed phase, there is understand, we amortize it. We amortize it from what date? From what date? From the date it is available for use. Now many a times the question will try to confuse you. The question will try to confuse you by giving the date of, this is the date by when the asset goes into commercial productions. Okay, so are we required to consider those dates? No, we are not required to consider those dates. Okay, date of commercial production, date of commencement of commercial production is not relevant, is not relevant. Okay, then third point, test for impairment only if, test for impairment only if the impairment indicators are triggered. Only if the impairment indicators are triggered. Okay, now comes the next question. How will we understand, or how will we get to know whether the development phase has started? Okay, how will we know from research we have entered into development phase? How will we get to know about that? Okay, by using the term pirate. Pirate. What is the meaning of pirate? Pirate means probable future economic benefits. I means intention to complete. R means resources to complete. A means ability to complete. T means technical feasibility. Technical feasibility. And E means expenditure can be measured. Expenditure can be measured reliably. Expenditure can be measured reliably. Okay, so this is what it is. Now, annual impairment. One more point. Tell me which are the assets which we test for annual impairment? Which are the assets which we test for annual impairment? The following assets. The following assets are to be tested for impairment annually at the same time every year. Which are the assets? Point number 1, goodwill acquired in business combination. Okay, now next intangible assets under development. Next, intangible assets with indefinite useful life. So these three assets are to be tested for impairment annually, irrespective whether the impairment indicator exists or not. Irrespective of whether impairment indicator exists or not. I believe it is very much clear to all of you. Okay, chalo. Now moving, so this completes our non-current assets 3 standards we have done so far. In 1 hour, in just 1 hour, we have completed 1 standard. Okay, tell me, if you would have done on yourself, will you be able to complete 3 standards in 1 hour? Do you think so? I don't think so. I don't think so. Okay, so definitely it saves on a lot of time. Okay, when we refer the marathon, these exam oriented marathon revision sessions. Right now, chalo, moving on to the next topic, that is borrowing costs. Okay, tell me guys, I need a heads up from all of you. Come on guys, I need a heads up from all of you. Are you understanding everything? Shall we move on to next chapter, borrowing cost? Ta-da-ta-da. Now first thing is core principle. First thing is core principle of borrowing costs. Okay, now what is the core principle? So if any, okay, understand, if the borrowing costs is incurred if the borrowing cost is incurred on borrowings or loans taken for construction, borrowings not taken, used for construction of qualifying asset, okay, then it is capitalized to cost of qualifying asset. Any other cases, it is expensed off to P and L under financing category. Is it clear? So if we have taken a loan, and we have utilized that loan for construction of qualifying asset, then the borrowing cost of that loan is capitalized to the cost of the asset, okay. Now any other borrowing cost is expensed off to P and L. Chalo, done. Now, what is the period of capitalization? I have seen many students making this mistake of not understanding the meaning of period of capitalization. Okay, so let us first of all understand the meaning of period of capitalization, then we'll move further. Okay, students are asking what is included in this marathon. This includes the full syllabus. If you can see here, we have just completed 9 pages out of 101 page, right? So just understand the volume. 101 page you have to complete. Means entire syllabus. Commencement of capitalization. When are we going to commence? Okay, when all the below 3 conditions are satisfied. The date when all the 3 conditions are satisfied. From that date we will start capitalizing the borrowing cost. What is? Expenditure is being incurred, borrowing costs is incurred, and construction activities has started. When all the 3 are satisfied, we start capitalizing the borrowing cost to the cost of the asset. Okay. Now, suspension. When the construction work, if the construction work is stopped for abnormal reasons, then we suspend the capitalization. Suspend means stop, pause the capitalization for that period. Now, what is the meaning of it? Let's suppose we are in a hill station. Okay, the government plans to make a road in the hill station. Tell me, in hill stations, landslide is normal. So let's suppose work stops due to landslide. It is a normal reason. Okay, and if the work stops due to normal reason, will we suspend the capitalization of borrowing cost? No. But let's suppose we are making the road in the city of Mumbai. Is in the city of Mumbai like something like landslide? Is it normal? No. But some out of nowhere a landslide happens in Mumbai city, and the work stops. That is abnormal reason. Okay. So if the work stops due to abnormal reason, highlight the word abnormal, then we suspend the capitalization for that period. Cessation. When the construction is complete, cease. Cease means stop. Stop capitalization. Stop capitalization of borrowing costs. Done. Okay, chalo further. Now the borrowings are of 2 types. General borrowings or specific borrowings. Now, general borrowings means I have multiple borrowings. And I have used the existing borrowings for the construction. What is the meaning of specific borrowings? Let's suppose I wanted to construct a studio for my classes just here, just beside this. Okay. Now I have taken a loan specifically for that construction. I have taken a loan from bank specifically for that construction. That is called as specific borrowings. Now, under general borrowing, what we do is we first of all compute the average capitalization rate and apply that average capitalization rate. First of all, we compute average capitalization rate, and then we apply this average capitalization rate to the expenditure incurred in period of capitalization. Okay. Now, so I have taken up an example for this. Please understand. See here. See, VJ Limited, Vishal Jain Limited, my company. Okay. Now, had following borrowings. This loan at 10%, this much loan at 8%. So I have two general borrowings. Now I planned to construct a studio class, not warehouse. What will I do with the warehouse? Studio. I plan to construct a studio and spend the following amounts. These are the amounts which I spent. Construction work completed on 30th September 20x1. Compute the costs to be capitalized. So first of all, here I will have to compute the average capitalization rate. Average capitalization rate. Tell me, what is the total borrowings? 1 million at 10% is 100,000 plus 1.5 million. 1.5 million multiplied by 8% is 120,000 divided by what is the total borrowings? 2.5 million. So what is the amount? 220 divided by 250. 8.8%. 8.8%. Okay. Now, how will I capitalize it? Copy. Okay. When is the construction getting complete? 30th September 2007 x1. Don't forget this date. Okay. Now, so I will say 150,000 multiplied by 8.8% multiplied by, from 1st January till 30th September. How many months? Tell me. Jan, Feb, March, April, May, June, July, August, September. 9 months. So into 9 by 12. Here again, 220,000 multiplied by 8.8% multiplied by from 1st April to 30th September. April, May, 6 months into 6 by 12. Now 100,000 multiplied by 8.8% multiplied by how many months? August, September, 2 months. 2 by 12. So what is the amount? Can you please tell me? 150,000 into 0.088 into 9 by 12. 9,900. Then 220,000 into 0.088 into 6 by 12 is 9680. 9680 and 100,000 into 0.088 into 2 by 12 is 1467. 1467. 1467. So what is the amount to be capitalized? 9900 plus 9680 plus 1467. That comes to 21047. 21047 is the amount of borrowing cost that has to be capitalized. Is that clear, everyone? You understood how do we compute the amount to be capitalized in case of a general borrowing? Clear? Chalo. Now moving on to specific borrowing. What are specific borrowings? Loan taken okay, loan taken specifically for the construction. Okay, now in this case, how do we capitalize? In this case, how do we capitalize? Amount to be capitalized is equals to actual borrowing costs incurred in the period of capitalization. Actual borrowing cost incurred in the period of capitalization, irrespective of funds used or not. Doesn't matter whether we have used the funds or not, doesn't matter. Okay, total borrowing cost for the period of capitalization less investment income. Okay, chalo, I have an example for this also. I have taken up a loan of $10 million at 9%, and we have taken the loan on 1st January 20x2. The construction activities started on 1st April 20x2, and on that date itself I spent $7 million. Tell me, what should be the date of commencement of capitalization? Please understand, this is the date when we have taken the loan. Shall we start capitalizing it from this date? No. Three conditions. Borrowing cost incurred from 1st January, expenditure happening from 1st April, construction activities starting from 1st April. So we'll start the capitalization from 1st of April 20x2. Okay, now when is the construction getting over? 30th November 20x2. So actual borrowing cost incurred in this period. What is the actual? We have taken a loan of 10 million multiplied by 9% multiplied by April to November. April, May, June, July, August, September, October, November, 8 months multiplied by 8 by 12. This is the actual borrowing costs. Doesn't matter whether we have used the funds or not. The amount is, can you tell me the amount? 10 into 0.09 into 8 by 12 is 600,000. Less investment income. What is the investment income? See, we took a loan of 10 million. Okay, we spent 7 million on 1st April, means 3 million was idle from 1st of April till 1st of July, means April, May, June, 3 months. Okay, so 3 million was idle for 3 months. Okay, what is the investment income at 5%? Multiplied by 5% multiplied by 3 by 12. How much? $3,750. So what is the amount to be capitalized? It is 600,000 minus 3,750. 596,250. 596,250. It is 37500, guys. I'm so sorry. 500. 600,000 6 minus 37500. 562,500. Clear now? Okay. Now, but let's suppose if we solve this same question for general borrowing, can you do that? Now, if it is for general borrowing, now we have to give emphasis to 7 million and 3 million. Average capitalization rate will be 9%. Okay. So now what will happen here? So it will be 7 million multiplied by 9% multiplied by 8 by 12, then 3 million multiplied by 9% multiplied by July, August, September, October, November, 5 months into 5 by 12. So what is the amount to be capitalized? 7.09 into 8 by 12, 420,000. These 5 by 12, 112500. So amount to be capitalized is 532500. I believe you have understood the difference between specific borrowing and general borrowings. Okay. Now, one more thing. Any borrowing costs incurred, and investment income from 1st January 20x2 till 31st March x2 will go to P and L. Okay. Now, similarly, any borrowing costs from 1st December 20x2 till 31st December 20x2 will also go to P and L. Means any borrowing cost or investment income pre the capitalization period or post the capitalization period will go to P and L. Why I'm writing here? The period of capitalization in this case, will be from 1st April 20x2 till 30th November 20x2. Keep this in mind always. I believe it is very much clear to all of you. Come on, guys. So we have completed the second chapter as well. Come on, guys, tell me. Give me a heads up. All of you, come on, guys, tell me. Is that clear, everyone? Is that clear, everyone? Come on, guys, tell me. Now we'll complete one more standard and then I'll give you break. I will complete one more standard, a very, very small, pyara se standard. Yes, Kusi. Everyone, the josh should be high and the internet should recover. And I believe, see, just because of our energy, our josh, our positiveness, I believe the internet has recovered also. I believe so, right? The internet has recovered also. Touch wood. Touch wood. Chalo. Impairment of assets. Now, what is the process of impairment? So please understand, at each reporting date, we need to evaluate, the entity needs to evaluate if impairment indicator exists or not. If impairment indicator exists or not. Okay. Now, please understand. If indicator exists, if impairment indicator exists, if impairment indicator does not exist, if impairment indicator does not exists, if it exists, test the asset for impairment. Test the asset for impairment if the impairment indicator exists. But tell me, will we test it annually? No. At each reporting date, we need to assess if the impairment indicator exists or not. You are getting my point, I believe. Okay. If it exists, then we test the asset for impairment. Now, when we test the asset for impairment, evaluate recoverable amount. Evaluate recoverable amount. Now, there can be three situations. Situation number one, recoverable amount is greater than carrying amount, or recoverable amount is equals to carrying amount, or recoverable amount is less than carrying amount. Now understand, if recoverable amount is more, means asset is fully recoverable, no impairment. Again, asset is fully recoverable, again, so no impairment. Again, here also no impairment. But if the asset is not fully recoverable, my dear friends, asset will be impaired here. Okay, now if the impairment indicator doesn't exist, no further treatment. Is that clear, everyone? The process of impairment, is it clear, everyone? Now, I have an example to explain the understanding of impairment. Okay, this example will give you a detailed understanding of impairment. Do you want to solve this example? Come on, guys, tell me. Do you want to solve this example? This example, I can assure you, it will give you a detailed understanding on the impairment solution. Do you know from where I have got these examples? Yes, it is for June exams only. Do you know from where I have got the examples? I have just made it a crux from the past exam questions. It's a crux. Now understand. So it says you purchased an asset for $1,000. Life is 10 years. Tell me what will be the depreciation per year? Depreciation per year will be 100. I believe it is clear. Now, recoverable amount is given. Okay, now understand. So at each reporting date, we have to test it for whether the impairment indicator exists or not. At year end 1, no impairment indicator exists. So tell me, will we test for impairment? No. At year end 2, impairment indicator exists. Underline. Then we have to test, hence test for impairment. We have to test for impairment. Now tell me, what will be the carrying amount? At year end 2, 1000 minus 100 into 2 is 800. What is recoverable amount? Recoverable amount is 1200. Okay, no impairment loss. Is that clear, everyone? Chalo, done. Let's move on to the next year. Then year end 3. At year end 3, no impairment indicator exists. At year end 4, impairment indicator exists, and hence test the asset for impairment. Now, what will be the carrying amount? 600. What is the recoverable amount at year end 4? 450. Okay. Now, hence, what will be the impairment loss? Impairment loss will be 150. Is that clear, everyone? Now, hence, what will be the revised carrying amount? It will be 450. Now, what will be the revised depreciation per year? It will be 450 divided by remaining life is how much? 6 years. It is equals to how much? 450 divided by 6 is 75. Okay. Now, again, year and 5, no impairment. Year and 5, no impairment indicator exists. Year and 6 also no impairment indicator exists. Now at year and 7, impairment indicator exists, and hence we test. Now understand here what happens. At year end 7, impairment indicator due to which asset was impaired originally reverses. Okay, hence test the asset for reversal of impairment. Test the asset for reversal of impairment. But what will be the carrying amount? It will be, first of all, 450 minus 75 is the depreciation per year. We have to charge for how many years? We have to charge the depreciation for 5, 6, 7, 3 years. We have to charge the depreciation for 3 years. So what is the carrying amount? 225. Okay, what is the recoverable amount? Recoverable amount is 350. Now tell me, can I say reversal of impairment loss will be equals to 350 minus 225? Can I say it will be 125? Tell me, guys, can I say it will be 125? No. Why? Because a reversal is restricted up to a maximum of carrying amount had there been no impairment, which is equals to how much? 1000 minus 100 multiplied by 7, which is equals to 300. So you can reverse up to 300 only. So therefore reversal is equals to 300 minus 225 is equals to 75. Tell me, is that clear? I'll highlight this in red color. Is it clear, everyone? Come on, guys, please tell me. Clear, everyone? Okay, so with this one example, we understood the process of impairment, we understood the how to charge the impairment, we understood each and everything. Now comes accounting treatment of impairment. How do we account for impairment? Let me explain that also. Accounting treatment of impairment. Guys, tell me, is it giving you confidence? Are you getting confidence? If the asset is under a cost model, if the asset is under a revaluation model, now, if the asset is in a cost model, impairment loss is recognized in P and L. But if the asset is in the revaluation model, then in that case, impairment loss is recognized in other comprehensive income. To the extent there is a balance in a revaluation reserve. any excess impairment loss is recognized in a P and L. Now, one student was asking, sir, can you please take numbers and explain this part? Okay, let me do that for you guys. Okay, let me do that for you. Hold on a minute. Whatever you guys demand, I definitely try to help you with the same, but only thing is it should be genuine and possible for me. Rest everything I can do it for you guys. Okay, now impairment loss of 1. See, revaluation gain, I believe this treatment is very much clear to you, right? Impairment loss of 140. What is the balance that you have in revaluation is a 100, right? So what will you do? In other comprehensive income, impairment loss of 100. In P and L, you will record, in P and L, you will record 40, and rest revaluation reserve will become nil. Is that clear now? Is that clear now? So I can say only one thing here, crux. Treatment of revaluation loss under IAS 16 and IAS 38 and impairment loss IAS 36, okay, for asset under revaluation model is same. Crux. I believe it is very much clear to all of you. Come on guys, tell me, is it clear? Is it clear, everyone? Okay, now moving on to the next. What is a recoverable amount? What do you mean by recoverable amount? So recoverable amount is higher of what? Fair value less cost to sell and value in use. Now, what is the meaning of value in use? So please understand, fair value less cost to sell means fair value as per IFRS 13 minus costs to sell or dispose. Okay, now what is the meaning of value in use? Present value of expected cash flows from use of the asset and present value of residual value of asset. Okay, discounted at pre-tax rate. Now, while computing value in use, please keep in mind. We are not required to consider the cash flows due to restructuring, future enhancements. Okay, all these we will not consider. Do not consider cash flows. Additionally, do not consider finance costs and income taxes as well. Okay, then while estimating the future cash flows, you should take reasonable and supportable assumptions. Your assumptions should not be ad hoc, it should be supported by some basis. Greater weight should be given to external evidence. You should take most recent financial budgets and forecasts okay, to estimate the future cash flows, and you should take a maximum period of 5 years, not more than that. But if you want to take up for a cash flows for a period more than 5 years, you can do so if a longer period can be justified. Then you have to justify why are you taking something more than 5 years. Okay, now concept of associated liabilities. So while computing recoverable amount, while computing, I don't know why you guys are worried about will this video be uploaded or not. Don't you think it will make more sense to study in the current position, make use of the best use of the time? While computing recoverable amount, we need to adjust for associated liabilities. We need to adjust for associated liabilities if if it is not separable. If it is not separable, if it is not separable, we have to adjust it off. Okay, for example, can be one example can be provision for decommissioning, removal or restoration costs. So read this example again. This question is coming from a past paper. At 31st December 2007, Bismuth company owns mines which have a carrying amount. Asset carrying amount is 200 million. The company has committed itself to decommissioning, and decommissioning provision is 53 million. Decommissioning provision is 53 million. Okay, directors have received a quotation of 130 million from a buyer who will assume the decommissioning obligation as well. So understand here in this case what is happening. Solution, tell me what is the carrying amount of asset? 200 million. Okay, now what is the fair value less cost to sell? It is 130 million, but this fair value less cost to sell is net of decommissioning obligation. It is net of decommissioning obligation, because if we sell, I will not keep the obligation with myself and sell the asset only. No, that cannot be the case. I will sell this asset along with the decommissioning obligation. Now what is the value in use? What is the value in use? The value in use is present value of the future cash flows is 220. Sorry. 20 plus sale of output is 203 minus cost is 48. Okay, so this gives me the value in use of 20 plus 203 minus 48 is 175. But now the challenge is this carrying amount of asset and value in use is not net of decommissioning. Tell me, will it make sense to compare it? No, because it is net of, this is net of decommissioning, but these two are not net of decommissioning. So we have to make them net of decommissioning. That is 200 minus 53. 200 minus 53 is 147. Okay, minus 53. So 175 minus 53 is 122. So what is recoverable amount? Higher. What is recoverable amount? Higher is 130. So therefore impairment loss of how much? 17 million. Is it clear, everyone? Chalo. Moving on to the next adjustment. Concept of CGU. What is the concept of CGU, guys? Can you please tell me what is the meaning of CGU? CGU is a smallest identifiable group of assets, smallest identifiable group of assets capable of generating independent cash flows. Capable of generating independent cash flows. What this is the meaning of CGU. Okay, smallest. Please understand the word smallest is very important here. The word smallest is very important here. The word capable of generating independent cash flows is also very important here. Okay, now what is the treatment of CGU? What is the treatment of CGU? How do we test a CGU for impairment? How do we test a CGU for impairment? Okay, so we compute carrying amount of CGU. We compute carrying amount of CGU. We compute recoverable amount of CGU. We compute impairment loss of CGU. Now, how to allocate the impairment loss? How to allocate the impairment loss? Impairment of CGU. Now, how to allocate? Yes, we will complete impairment and then we'll take a break. And yes, guys, internet has restored itself. Everything is fine now. Everything is fine now. I believe you will not face any such lag issues now. Okay, from now onwards, no lag issues will be coming up. If you work hard, God will also support you. Thanks to God for supporting me in this marathon. Now, how to allocate the impairment loss? How to allocate the impairment loss? First of all, to specifically impaired asset, then to goodwill, and then remaining impairment loss. Remaining impairment loss will be applicable, will be allocated to remaining applicable assets in the ratio of their carrying amount. Now you will ask me, sir, what is the meaning of remaining applicable assets? So note, applicable assets for IAS 36 includes PPE, IP, intangible assets. Okay, again write a note here. Applicable assets for IAS 36 does not include inventories, current assets, trade receivables, financial assets, deferred tax asset or liabilities, biological assets, I believe this is very much clear to all of you. Okay, chalo. Now, what if, now my next point is, what if CGU has goodwill? Now understand, the question says, the standard says the goodwill are of two types. Goodwill are of two types. Okay, one is allocable goodwill, another is unallocable goodwill. If the goodwill is allocable, then allocate the goodwill to the CGU and test the CGU for impairment. Right? If it can be allocated, then allocate and test. Okay, but if it cannot be allocated, the real challenge lies here. What if goodwill is unallocable? Okay, then we follow two-stage approach. Now, what is two-stage approach? Let me guide you. ना ऐसे नहीं भाई. Two-stage approach. So under stage one, we test the individual CGUs. Don't worry, I have got an example for you. Test the individual CGUs, excluding unallocable goodwill. Test the individual CGUs for impairment. Okay, this is stage one. Okay, now stage 2. Okay, now in stage 1, what will happen? If you test the individual CGUs for impairment without unallocable goodwill, means the individual CGUs are already tested for impairment. Now in stage 2, what will you do is, in stage 2 you will test the group of CGUs. To which the goodwill can be allocated. It can be an entire company also. Okay, for impairment. Group of CGUs to which that goodwill can be allocated. Okay, so I'll write here including unallocable goodwill. Now here what will happen? Whatever impairment loss comes up, let me write that, very important point. Whatever impairment loss comes in stage 2 will be allocated only and only to unallocable goodwill, and never ever to individual CGUs which are already impaired in stage 1, because they are already impaired now. Why do you have to test? Why do you have to impair them again? Is that clear, everyone? Chalo. Corporate assets. So I'll write here same treatment as goodwill, but one exception. The exception here is goodwill once impaired for life and cannot be reversed. However, impairment on corporate assets can be reversed. Clear, everyone? Now, do you want to solve an example on this one? Do you want to solve an example on this one? Come on, guys, tell me. Tell me, how is it like if you are watching the session and not liking the session? Very bad, very bad, very bad. Come on, guys. If you are watching the session and liking it, hit the like button right now. So, using the same approach, I am coming up with my book also. Okay, my SBR capsule book will be open for release within 10 days. It will be open for sale also for the students who are not enrolled with me as well. They will be able to purchase. Okay, this is just you can say one aspect of the capsule book, but my capsule book is much more detailed, everything. Okay. Now, when I launch my capsule book, I will definitely upload a video on that for all my students. Okay. Now, can you revise stage 2? Already done that. Chalo, solution. Now, see in this question, what is happening? First of all, there are two CGUs. Okay. Now, in the CGU, allocable corporate asset is already allocated to that. Allocable goodwill is already allocated. But apart from this, student is asking, can you revise stage 2? Buddy, don't worry. Using this example, your stage 2 will get revised. Don't worry. Focus on what I am teaching. Okay. Further, entity VJ Limited has recognized a goodwill of $90. Let me highlight this. And a corporate asset of $120, which cannot be allocated to CGU1 and CGU2. Okay, but it can be allocated to the entire VJ Limited. Okay, let me write that. But can be allocated to VJ Limited as a whole. Okay. Now, recoverable amount of CGU1, CGU2 and VJ Limited as a whole is this much. So what will you do? First of all, I will test CGU1 for impairment. I will first of all test CGU1 for impairment. Now tell me, what is carrying amount of CGU1? Can you please do the total? 300 plus 100, 400, 400 plus 100, 500. Carrying amount is 500 minus what is the recoverable amount? 390. So what is the impairment loss? 110. How will the same be allocated? How will the same be allocated? How will the same be allocated? So first of all, it will be allocated to goodwill, because there is no specifically impaired asset. So I will allocate to goodwill. How much? 40. Then what is the remaining? Remaining impairment loss, that is 110 minus 40 is equals to 70. will be allocated to what? Inventory? No. Corporate asset and plant and equipment. To plant equipment and corporate asset in the ratio of their carrying amount. Okay, so can you please tell me what will be allocated to plant and equipment, and what will be allocated to corporate asset? Can you please tell me, guys? It is equals to 70 multiplied by, what is the carrying amount? 300 and 100. So 70 multiplied by 300 divided by 400, it is equal to 70 multiplied by 100 divided by 400. Just if you can calculate the figures and tell me the amount. 70 into 3 by 4 is 53 and it is 17. I believe it is very much clear to all of you. Right now, similarly, we have to test CGU2 also for impairment. Similarly, we have to test CGU2 also for impairment. CGU2, this is stage 2. This is stage 1 which we are into. Currently, we are in stage 1. We are testing the individual CGUs. So let me write that also. Let me write that stage 1. This is stage 1. This is stage 1. In CGU2, what is the carrying amount? 500 plus 100, 600, and the recoverable amount is 570. 600 and 570, 600. 600 and 570 is 30. It will be allocated to, first of all, goodwill 20, and remaining impairment loss, that is 30 minus 20, that is 10, will be allocated to what? Will be allocated to plant and equipment. Will be allocated to plant and equipment because there is no corporate asset here. So it will allocate to plant and equipment. Okay, done. Now comes stage 2. Now comes stage 2. Now under stage 2, what will happen? Under stage 2, what will happen? Under stage 2, you will take CGU1 carrying, okay, CGU1, CGU2, you will take unallocable goodwill, you will take unallocable corporate asset. What are the amounts? Can you please tell me amounts? CGU1 after impairment is 390. CGU1 after impairment is 390. Let me just draw the table. It will be easy for both of us. Now, tell me what is the value of CGU1 after impairment is 390, after impairment is 570, goodwill unallocable was 90, and corporate asset was 120. So tell me what is the total carrying amount? Can you please tell me? 390 plus 570 plus 90 plus 120 is 1170. What is the recoverable amount? Can you please tell me? Of the VJ Limited as a whole is 970. 970. So what is the impairment loss? What is the impairment loss? 200. Now how will you allocate this impairment loss? Allocation. So allocation first of all will happen to goodwill. Unallocable goodwill. How much? 90. Rest to unallocable corporate asset. How much? 110. 110, and we are done with it, and we are done with it. Now someone might have a query, sir, what if this impairment loss, sir, what if this impairment loss exceeds the total of this one, that is 90 plus 120 is 210. What if this impairment loss is not 200 or it is 300? Then it we will be done with the impairment of these. We have to anyway touch these two, right? So let me tell you, the maximum impairment loss, that can happen will be 210. Impairment loss will never come more than 210. Do you know why? See here, the recoverable amount of CGU1 is 390. Recoverable amount of CGU2 is 570. Means if a company has two divisions, 1 and 2, division 1 is earning 390, division 2 is earning 570, means the company overall will earn a bare minimum of 390 plus 570, that is 960, a bare minimum, right? So the lowest possible recoverable amount can be 960, meaning thereby highest possible impairment loss can be 210, means there will be no scenario where the impairment loss will exceed these two. Okay, I believe it is clear. Tell me guys, is stage 2 clear to all of you? Is stage 2 clear to all of you? Come on guys, please tell me. So in just 2 hours, we are done with these standards. I think we are done with 4 standards, not 4, 5 standards. We are done with 5 standards: property, plant, equipment, intangible assets, investment property, borrowing cost, and impairment of assets. 5 standards done in just 2 hours. And we have went into the smallest details also, right? We have actually went into the smallest details also, which otherwise you would have missed. So now the next chapter will be IFRS 5, which will start after a break of 15 minutes. So now here we are taking a break. Break of 15 minutes. But be back right here after the break. Come on, guys. Shall we resume back? Shall we resume back? Chalo, done. So let us start with a new standard, that is IFRS 5 non-current assets held for sale. Okay. Now, now before the next break, we are having a plan to cover IFRS 5 non-current asset held for sale, then leases, and if possible financial instruments as well. Okay, so we'll complete these three standards and then we are going to take a break. Okay, so you are not asking me for any break before that. Deal? Come on, guys, tell me. Deal? Is that a deal, all of you? Okay, chalo. So first point is IFRS 5. What is the classification of a non-current asset held for sale? So how do we classify? How do we classify? Okay, so we classify using two conditions has to be satisfied. Okay, below two conditions has to be satisfied. Has to be satisfied for classifying the asset as held for sale. Okay, now what are the two conditions? What are the two conditions? Pehla, first, asset should be available for immediate sale in its present condition. Then sale must be highly probable. The sale must be highly probable. Now, for the sale to be highly probable, these five conditions has to be satisfied. Management must be committed to a plan. To a plan to sell the asset. Okay, active program to trace buyer. Then reasonable price. Sale is expected to happen within 12 months and no significant changes to plan. Okay, and hence you can classify the asset to be held for sale if both the conditions are satisfied. If both the conditions are satisfied, you can light it below. Both two conditions has to be satisfied. Both has to be satisfied. Okay, I am writing here bracket, both has to be satisfied. Now, if a asset is classified as held for sale, what is the accounting treatment for the same? Okay, on date of classification, we recognize the asset at lower of carrying amount or fair value less cost to sell, whichever is lower. So highlighting the word lower of, Okay, now when you classify an asset as held for sale, will it still continue to be a non-current asset? No. Presentation, it should be recorded under other current assets. Okay, it should be recorded under other current assets. Okay, and any impairment loss is recognized in P and L operating category. Okay, now subsequently, no depreciation, no revaluation, no impairment. Now, when I'm saying no depreciation, I mean to say, as per IAS 16, 38 or 40, no revaluation. Okay, again, no impairment as per IAS 36, no impairment. Okay, now only thing is record asset at lower of carrying amount or fair value less cost to sell. This is the only thing which you have to do. This is the only thing which you have to do. Now, one important point which I believe 99% student miss out on that. Okay, now which is reversal of impairment loss. Can I explain this with the help of an example? Tell me, guys. If you will say, sir, please, you have to tell me, please, sir, please, can you please take an example? Then only I will take example, or else I will not take example. Tell me, guys, do you want me to take the example? But for that, you have to tell me, please. Ta 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 ta. Okay, students are saying please. So what can I do if you are pleading me so much? So I have to take up example. Okay, fine. Let me take example. Chalo, let's suppose there is an asset. The cost of which is 1,000 and life is 10 years. Okay, tell me at year end 2 what should be the carrying amount? Tell me at year end 2 what should be the carrying amount? 800. Oh my god, brilliant students. Okay, now here the asset is classified as held for sale. Okay, as held for sale. I'll just write it. Held for sale is HFS. Okay, HFS. Held for sale. Asset is classified as held for sale, and fair value less cost to sell is 750. Tell me what is the impairment loss? 50. This will go to P and L, and the okay. please, Your Excellency. Okay, now. Okay, at year end 2, this is what is happening. Tell me yes or no. Now, but we have to do this at every reporting date, right? Now, let's suppose, chalo, at year end 3. Now, tell me what will be the carrying amount? Carrying amount will be 750. No depreciation. Let me write that. No depreciation. And here the fair value less cost to sell is equals to, let's suppose 720. So tell me what is the impairment loss? 30. Again P and L. Now at year end 4 what happens? When the carrying amount is 720. Okay, again no depreciation. Okay, fair value less cost to sell is given as 830. What to do? what to do? If we go by record at lower, then we have to record at 720. But IFRS 5 also considers a paragraph of reversal. It says that when the fair value less cost to sell is higher than carrying amount, then it is a situation of reversal. It is a situation of reversal. And how much reversal can we do? How much reversal? Okay, now the reversal should be up to a maximum of total impairment loss recognized. Up to a total impairment loss recognized. That much amount we can reverse. Tell me how much is the total impairment loss that we have recognized so far. Can anyone tell me, guys, how much is the total amount of impairment loss? Let me highlight 50, 30, 80. So we have recognized a total impairment loss of 80. So therefore a reversal of $80. Hence revised carrying amount is equals to 720 plus 80 is equals to 800, meaning thereby this goes back to the original carrying amount 800 here, right? So you cannot go beyond this 800. No, you cannot go. Okay, let me take up one more situation. I'm writing here case 1. I will take one more case. Case 2. At year end 4 itself, case 2. Okay, fair value less cost to sell is 780. Fair value less cost. Situation of reversal. The reversal should be up to a maximum of the total impairment loss recognized, that is 50 plus 30. Total impairment loss recognized is 80. Total impairment loss recognized is 80. Tell me what in this situation, what is the amount of reversal? Can anyone tell me? In the case 2, what should be the amount of reversal? 60, because maximum is 80. Here the reversal is happening 60. So reversal is 60. Hence revised carrying amount is 7020 plus 60 is 780. You guys are champions, yaar. You guys are champions. DJ, bravo. Understood? Now, the next concept. Ta-da, ta, ta-da. Discontinued operations. What is the meaning of discontinued operation? Can you please tell me? Okay, you can say can you tell me the meaning of discontinued operation? I want to see. It's a major line of business or a major geographical area of operations, or it is a subsidiary acquired exclusively with a view to resell. This is the discontinued operation. How do you account for discontinued operation? Do you write the line by line items, revenue, cost, gross profit, operating profit, all those things you write? No. You write a single line item. You write a single line item in P&L. Okay, that is post tax profit or loss from discontinued operations. Right now, Let me highlight that. Now, in SOFP, what do you do? In SOFP, just one more thing. Okay, it is presented after continued operations. Okay, and the company has to disclose the earning per share of continued operation, discontinued operation, and both. Now, in SOFP, if the assets are sold, then to no treatment. You de-recognize the asset, you de-recognize the assets, de-recognize. Okay, then but if the assets are not sold, then group of assets are presented under other current assets and group of liabilities, because in a business there can be assets and liabilities both. Group of liabilities are presented under other current liabilities. Okay, let me highlight that. Okay, now I believe it is very much clear to all of you. Okay, now can we do the net off? Netting off is not allowed. Netting off assets and liabilities is not allowed. One more point, guys. In this post-tax profit or loss, note, if discontinued operation is sold, we include gain or loss on sale as part of above single line item. One more point, note, if DCO is not sold, do not recognize expected gain or loss on disposal. No, we do not recognize expected gain or loss on disposal. No, we cannot recognize that. Okay. In this case, we can recognize fair value less cost to sell gain or loss in P&L. That's all. I believe it is very much clear to all of you. These are very small points, okay, which if you study on your own, might be you can miss out on that. Okay, I believe we are done with it. Tell me, guys, is it clear, everyone? Is it clear, everyone? Come on, guys, please tell me. So we are done with IFRS 5 and now we are starting IFRS 16 leases. IFRS 16. Do we need to by heart the name of the standard for the exams? Can anyone please tell me? Do we need to mug up the name of the standards? Not at all. First is lease inception date and lease commencement date. Chalo. Lease inception date, lease commencement date. Okay, now I'm making these notes for you guys so that you can also refer it. These notes will be the super notes for your revision. Trust me, guys. These notes will be the super notes for your revision. Palak, no need to hate IFRS 16. If understood properly, this standard is one of the easiest standards. But if understood properly, okay, so just bear with me, just study with me whatever I'm teaching, and I believe you will start loving IFRS 16. I can guarantee that to you. Now, lease inception date is a date when the contract is signed The date when the contract is signed or terms and conditions are agreed, whichever is earlier. Okay, now then what is the lease commencement date? What is the lease commencement date? Lease commencement date is the date when the asset is made available to the lessee. Okay, done. Now, initial accounting in the books of lessee. In the books of lessee. Chalo. First of all, lease liability. Lease liability. Now, please understand, whenever you get a question of lease in the books of lessee, always check lease payment are in arrears, that is end of year, or lease payments are in advance, that is beginning of year. Check that. Now, if lease payments are in arrears, then lease liability is equals to present value of future lease payments. Okay, now in this case, lease liability will be upfront lease payment plus present value of future lease payments. I believe it is very much clear to all of you. Now, what is the value of ROU asset? ROU asset is equals to lease liability add upfront lease payments. Okay, or I'll just simply say it here, remove this. Okay, upfront lease payments in the case of advance, then add initial direct costs, then add present value of decommissioning, removal, restoration costs, and less lease incentives. Okay, so this is how you record lease liability and ROU. I believe it is very much clear to all of you. Now, what should be the journal entry? The journal entry to record lease. What should be the journal entry to record lease? Let me give you that understanding as well. So it should be ROU asset to lease liability to bank, debit, credit. Now, okay, this bank is upfront lease payments. Done. What is the treatment of variable lease payments? Can you tell me, guys? What is the treatment of variable lease payments? It is recognized in P&L as rent expense under operating category. Rent expense in P&L under operating category. What are lease incentives? Lease incentives are like discount given by the lessor to lessee. It's like trade discounts. Okay, it's an incentive given by the lessor to lessee, a discount given by the lessor to lessee. Chalo, what is the subsequent accounting treatment? lease liability. If lease payment are in arrears or lease payment are in advance, if lease payment are in arrears, you amortize, right? You amortize. So what will be the treatment? It will be opening lease liability plus finance costs on opening lease liability minus lease payments less lease payments is equals to closing lease liability. But if the lease payments are in advance, situation reverses. It will be opening lease liability, but first of all you have to pay, because payments are made at the beginning of the year. So from opening you will have to first pay, then add finance cost on net lease liability, that is opening minus lease payment is your closing lease liability. Is that clear? Is that clear? Okay, I believe we have discussed these things in very depth in our classes already, I believe, in my opinion. Okay, now what is the subsequent treatment of ROU asset? So ROU asset is depreciated over lease term. Over lease term, highlight lease term. But there are few exceptions. Exception number 1. Okay. Under exception, you depreciate over remaining useful life of asset. Now, what are the exceptions? Remaining useful life is less than lease term. We have taken an asset on lease. For 5 years, but we believe that we will be able to use the asset only for 3 years. So we have depreciated over 3 years and not 5 years. Okay. In the contract, purchase option exists and lessee is reasonably certain to exercise. Okay, then what else? The ownership of asset is transferred to lessee at the end of lease term. So this is an exception. Highlight this in red again. I believe it is very much clear. The 3 exceptions. Is that clear, everyone? Come on, guys, please tell me. Are the exceptions clear to all of you? Come on, guys. And if you are watching this session and not liking the session, it's not good. So hit the like button right now, all of you. Come on, guys, hit the right button right now. Subsequent treatment also done. What's next? Now, though not required, but can I talk about the classification as current or non-current also? Though not required, but might be required if a question comes up in group question number 1. It might be required. So I am talking about classification of lease liability as current or non-current. Okay, I'm talking about that also. So for that, first of all, you have to see lease payment are in. Guys, I'm telling you, I will be covering each and everything required for your exams. Just that you need to continue in this session till the very end. Don't go. It will be a loss for you in that case. Okay, I have put a significant effort in making these notes, and I am putting significant effort in taking these sessions. Okay, so study with me and it will be of great help. Now, lease payment are in arrears. Then tell me, what is the non-current part? What is the non-current part? It will be a balance of lease liability at the end of next year. And current is carrying amount of lease liability minus non-current portion. Non-current portion of lease liability. Chalo. What if the lease payments are made in advance? Then what will happen? Okay, then first of all, current is amount to be paid at beginning of next year. Non-current is balance of lease liability. Non-current is balance of carrying amount of lease liability less current portion of lease liability. Okay, done. Will these notes be helpful to all of you? Come on, guys, tell me. What do you think? Will these notes be helpful? Will these notes be helpful? Okay, chalo. Lease re-measurement. Lease re-measurement. Now, what is the meaning of lease re-measurement, guys? Please see here. I have also come up with a question on lease re-measurement, a full detailed question on lease re-measurement, which I'll be solving right now. Again, lease modification. I have got a question of lease modification, which I'll be solving right now. So stay very active in the class. Stay very active in the class. I will be discussing each and everything. Need not worry at all about it. Now, what is the meaning of lease re-measurement? So lease re-measurement means changes in the estimates. Changes in the estimates now of lease. Okay. Now, what is accounting treatment? So for accounting treatment, we need to understand things. Now, steps. Step 1, calculate carrying amount of lease liability on date of change of estimates. Step 2, calculate revised lease liability. Now, how to compute revised lease liability? Again, let me make a box for that. Okay, changes in index or guaranteed residual value or changes in reasonable certainty of exercising options. Okay, these are the two cases. Okay, now in this case it will present value of revised lease payments at original discount rate, and here it will be present value of revised lease payments at revised discount rate. Let me highlight this change. Okay, now ठीक है, now step 3 is calculate change in lease liability. Step 4 is make a corresponding change to ROU asset. Guys, if I would have wanted, I would have written all of these and came to class also, right? But I wanted to make an effort to write these in the class with you guys so that you relate to it. So that you relate to it. Getting my point? Now, how to calculate change in lease liability? It is step 2 minus step 1. Right now, chalo, let us solve the example for this now. Now, I will be highlighting the important terms in the example. Okay. Now, on 1st January 2003, LMN enters into a 5-year lease. So, initial it is 5-year lease. Initial is 5-year lease. Now, the contract gives LMN an option to extend the lease for a further 5 years. The lease rental for the first 5 years is 40,000, payable in advance. If LMN takes up the option, the lease rental will increase. For the extended period, the lease rental will be 50,000 per annum. Due to uncertainty about the level of revenue to be generated from the shop, LMN initially determines that extension option will not be taken up. Initially, it will not be taken up. LMN uses an incremental borrowing rate of 5%. So this is the rate of 5% which we'll use to compute the lease liability. So now can you please tell me solution? At 1st January 2003, on 1st January 2003, come on guys, tell me. Let me highlight this way so that you are able to relate to it properly. Yes. On 1st January 2003, what is the lease liability? What is the value of lease liability and what is the value of lease liability? So tell me, what is the value of lease liability? The lease payments are paid in advance. So it will be 40,000 plus what is the present value? What is the present value of remaining 4 lease payments at the rate of 40,000? 5%. 1.05 divided 1, 2, 3, 4 GT into 40,000. It is 141838. 141838. Okay. So your lease liability is, you can say this much. This is your lease liability, and your ROU asset is 141838 plus upfront lease payment of 40,000 is 181838. Is that clear, everyone? Come on guys, tell me. Is that clear, everyone? Come on guys, tell me. Done. Now further, based on the above information of the liability and asset, on 1st January 2006, immediately after the 4th installment is paid on 1st January 2003, 1st January 2004, 1st January 2005 and 1st January 2006. So after the 4th installment, means 1 installment is remaining now. In the original contract of 5 installments, 4 installment is already paid, 1 installment is remaining. Okay, it says this is the carrying amount of lease liability and ROU. Sorry. Okay, now it says on 1st January 2006, the director of LMN decided that they would take up the offer of 5-year extension. Now they want to take up the offer of 5-year extension because the sales had exceeded the expectation. And now since the option is changing, right? So I will take revised discount rate or original discount rate. Come on guys, please tell me. I will take revised discount rate or original discount rate. Tell me. I will take to calculate 6% or I will calculate using 5%. Tell me guys, come on. 5 or 6? 6% now. Okay, so now here, copy on 1st January 2006, carrying amount of lease liability is how much? 38098. 38098. Now revised lease liability is equals to revised lease liability is equal. So first of all, I have to compute the present value of one lease payment of 40,000, which is 40,000 multiplied by what is the 1 year discount factor, 0.943, 0.943. Then we have to compute the present value of the remaining 50,000 for 5 years, right? So what is the discount factor? It is for 6 years, it's 4.917. 4.917 is for 6 years, but we need for 5 years. So minus 0.943, it is 3974. 3.974. Can you compute the value? 40,000 into 0.943 is 37720 plus 50,000 into 3.974 is 198,700 is equals to plus 37720 is 236,236,420. So what is the change in lease liability? It is equals to 236,420 minus 38098 is equals to minus 38098 198,322. Okay, so what will be the journal entry? What will be the journal entry? Insert table. Now the journal entry will be, see what is happening, lease liability is increasing, right? So we have to increase ROU asset to lease liability, debit credit. How much? 198,322, 198,322. Is that clear everyone? Come on guys, please tell me. क्या बोलती public? Was this question difficult? Now tell me, was this question difficult? I don't think so, guys. It was a pretty easy question. Just that you need to apply your brain. Just that we need to apply your brain. Not brain, brain. I think I need water now. What is lease modification? Come on guys, tell me what is lease modification. It is a change in terms and conditions of the contract. The contract itself is changing. The contract itself is changing. See here again, we need to understand. Here the estimates was changing. In lease remeasurement, estimates was changing. In lease modification, terms and conditions, the contract itself is changing. In lease remeasurement, contract was not changing, our estimates was changing. Okay, so if our estimates change, we calculate carrying amount, we calculate revised, we calculate change of lease liability, make a corresponding change to ROU asset. Simple. Now lease modification. So lease modification are of three types. First is increase of scope. It says your scope increased. If your scope increases, let's suppose earlier I had only one floor. I took only one floor in lease. Now I have taken 2 floors on lease. So scope increases. If your scope increases, your lease payment will also increase. Now, so standard is saying if the increase in lease payment commensurate, if the increase in lease payment commensurate with increase of scope, if the lease increase in lease payment commensurate with increase of scope, commensurate with market rate for increase of scope, then it is a separate contract, then it is a separate, treat it as a separate lease, separate lease contract. Separate lease contract means you will consider this date as lease commencement date, and you will recognize ROU and lease liability separate, as if it is a new contract, as if it is a new contract. But please understand, note, if lesser, see, understand, I have taken a lease. Okay, I am lessee, you are lessor. Okay, you had a building where in the building there were 4 floors. I took only 1 floor on rent. Okay, now second floor is vacant now. Second floor is vacant now. If the lessor has to find a new tenant for that, if the lessor has to find a new lessee for that, lessor would have incurred some costs. But now since the lessor is giving to the existing lessee, lessor will save on those costs. Okay, so if lessor passes the benefit of savings to lessee, okay, then also it is considered at market rates. Okay, I am highlighting this in red. See, these are small points which will be difficult for you. That's why I am highlighting these in red. Okay, now clear everyone? Decrease of scope. So here two-stage approach, two-stage accounting. Two-stage accounting happens. Two-stage accounting happens. Stage 1. Stage 1, decrease or reduce lease liability and ROU proportionately, and recognize the impact in P&L. Okay, proportionately reduce. Let's suppose previously I had taken 3 floors, but now previously I had taken 2 floors, but now I am taking only 1 floor. Scope decreased by 50%. So reduce lease liability and ROU by 50%. Reduce lease liability and ROU by 50%. Then this is stage 1. Now moving on to stage 2. Stage 2. Stage 2 is calculate carrying amount of reduced lease liability, calculate revised lease liability, that is present value of revised lease payments at revised discount rate, calculate change in lease liability and make a corresponding change to ROU asset. Tell me, is it clear, everyone? Is it clear, everyone? similar to lease remeasurement. This stage is similar to lease remeasurement. Okay, now I have an example also, don't worry. I'll take up an example and explain. Now, let me just copy it off here. Copy. And any others, we just follow this one. Calculate carrying amount of lease liability. Calculate carrying amount of lease liability. Calculate revised lease liability, present value of revised lease payments at revised discount rate. Calculate change in lease liability, make a corresponding impact to ROU asset. Okay, chalo. Now I have an example. Tell me, out of these three cases, tell me, don't you think this is exactly like lease remeasurement? Tell me, don't you think it is exactly like lease remeasurement? Come on, guys, tell me yes or no. Carrying amount, revised, change, carrying amount, revised, then calculate change, and then make a corresponding impact to ROU. Then make a corresponding impact to ROU asset. It's exactly like lease remeasurement, just that we are using revised discount rate here, right? Now, so this is sorted. Now, this one is again a new contract itself. So again, this is also sorted. Now, I believe you will face challenge in this part. Tell me yes or no. I believe you will face challenge in this part. Tell me yes or no. So do you want me to take up example for this? Do you want me to take up example for this? But you have to say please for that. You have to tell me please. You have to request. Then only I will take. Otherwise, no. See, all the students are so obedient. They are following my words. Thank you, guys. Thank you. Since you guys are insisting a lot, I am taking up an example. Otherwise, I would have not taken. But since you guys are insisting this much, okay, you are telling please. So let me take it up. Okay, chalo. Example. On 1st January 20X3, FGH entered into a lease contract to lease 2 floors. Keep this in mind. Okay. Lease 2 floors. Initially, we have taken 2 floors. Okay. The lease is for a period of 10 years with an annual rental of this much. Borrowing rate initially is this much. Okay, now on initial recognition, see, question is so good. The question setter is so good. They have calculated the lease liability and ROU and given it to you. Okay, the lease rent is payable in arrears. Highlight that. Lease rent is payable in arrears. Highlight that. Okay, now, so first of all, I will write here on solution. On 1st January 20X3 and then on 1st January 20X7. La 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 la. Chalo. So now tell me, on the date of lease commencement, you will recognize lease liability of how much? 736,000. Question is giving you this data. Let me highlight this with a different color pen. 736,000. Since the lease payment are in arrears, ROU will be the same amount. Is that clear? ठीक है, चलो now. Now the question actually starts from this date. On 1st January 2007. On 1st January 2007. Step 1. Let me write this in pointers. merge stage 1. Step 1, carrying amount of lease liability, carrying amount of ROU is given in the question. How much? 491722 and 441600. 491722 and 441600. Okay, take it now. On this date, FGH arranged with a lessor to continue with the lease for just one of the floors, reducing the space leased by 50%. So tell me what I have to do as part of step 2. What I have to do as part of step 2? Reduce lease liability by 491722 multiplied by 50%. Reduce ROU asset by 441600 multiplied by 50%. Proportionately reduce them off. What is the amount? Can you please tell me? 491722 into 0.5, 245861. And what is this amount? 441600 into 0.5 is 220800, and hence the entry will be lease liability to reduce to ROU to okay. Now lease liability will be debited, ROU will be credited, now lease liability will be debited by 245861. ROU, sorry, this is, yes, ROU will be credited by 220800, and hence the difference goes to P and L. Credit. How much? 245861 minus 220800 is 25061. Tell me, is that clear, everyone? Is that clear, everyone? Now step 3 is what is reduced lease liability is equals to 491722 minus 245861 is equals to 245861. This is stage 1. Now we are moving on to stage 2. Under stage 2, step 1. Step 1. What is the carrying amount of reduced lease liability? It is 245861. Step 2 is what is revised lease liability. So present value of the revised lease payments at revised discount rate. So the lease rental for the remaining 6 years of the lease was 55,000 per year, and 6 year annuity factor is this much. So 55,000 into 4.767. 55,000 into 4.767, it is equals to 55,000 into 4.767 is 262,185. So step 3 is change in lease liability is equals to 262,185 minus 245,861 is equals to minus 245,861 is 16324. Step 4 is make a corresponding change to ROU asset. So which will be equals to your lease liability is increasing. So your answer will be ROU asset debit to lease liability credit, no P&L impact, by the amount 16324. 16324, and this, let me highlight it in red. Is that clear to everyone? Come on guys, tell me. Is that clear to everyone? Come on, guys, tell me. So how beautifully we have understood the stage 1 and stage 2. Is that clear? I believe now if you've understood this, you will never face any challenge in the lease modification or lease remeasurement. I have taken up an example also and explained. I believe that's the best way to study. Now comes the next part, that is recognition exemptions. What is a recognition exemption? Okay, a lessee is not required. So understand, recognition exemption is available only to lessee, not to lessor. Only lessee. A lessee is not required to recognize lease liability and ROU. Okay, rather all the lease payments are recognized as rent expense in P&L at straight line basis. Okay, now this P&L will be an operating category as per IFRS 18. Now, so in which situation? Under you can say lease term up to 12 months or low value asset. What is the meaning of low value asset? It can be tablet, a mobile phone, a laptop, a printer, etc. Okay, is it clear, everyone? Now coming to lesser accounting. Coming to lesser accounting. Now, how do we see? Lesser has to classify whether it is an operating lease or a finance lease. How to classify? First of all, can you please help me with the classification? Can you please help me with the classification? Ownership transfer. Ownership transfer. Okay. You can write indicators for finance lease. Ownership transfer at end of lease term. Lease term forms substantial part of useful life. Then present value of future lease payments forms substantial part of fair value of asset. Okay, asset is of specialized nature, right? Purchase option at a nominal price. Okay, then it is a finance lease, otherwise it's an operating lease. Now, how to do the accounting treatment of operating lease, normal finance lease and finance lease for manufacturer dealer? Okay, it has all the lease payments are recognized as rent income in P&L at straight line basis. Now I believe you know the meaning of straight line basis. See, I talked about straight line basis here also. I talked about straight line basis here also. I believe you know the meaning of straight line basis. So let me explain using the help of an example. So let's suppose example is rent of year 1 is 5,000. Year 2 is 6,000, and year 3 is 7,000. So rent expense will be equals to 5,000 plus 6,000 plus 7,000 divided by 3, average. 5 plus 6, 7, 11, 11 plus 7, 18, 18 minus by 3 is 6,000. Okay, so 6,000 is the rent expense per year. This is called as straight line method. Okay, now under finance lease, recognize lease receivable at present value of future lease payments at implicit rate of lease. Okay, then de-recognize the asset difference is recognized in P&L. Subsequently unwind lease receivable and record finance income. This finance income will go to investing category. Okay, now initial treatment, subsequent treatment. Now, if it is a manufacturer dealer, then initial treatment will be to recognize revenue and lease receivable at present value of future lease payment. But how does it differ? So here what happens, it is not only future lease payments, it is including future lease payments and UGRV, unguaranteed residual value. Unguaranteed residual value both. Let me highlight it in red. And here it is only future lease payments, the amount that we receive from lessee. Then recognize cost of sales as difference of cost of asset minus cost of asset minus present value of your unguaranteed residual value. Now subsequently will be the same. Subsequently will be the same treatment. Clear everyone? Is it clear everyone? So this is the treatment of finance lesser accounting. Okay, now comes the next topic, that is sale and lease back. Sale and lease back. Now what is sale and lease back? What is sale and lease back? Okay, now basically I sell the asset and then take it back on lease. I first of all sell the asset and then take it back on lease. Now don't worry, we are just about to complete this. We will take an example of sale and lease back, then identifying lease, and here we are done. Here we are done with this chapter. Okay, just we are about to complete lease. We are about to complete lease. Okay, don't lose out on the patience. We are about to complete lease, and if required, we'll take a break after lease. Don't worry at all about it. Okay, let us complete now. But if the transfer, see, understand, we sell and then take it back on lease. When we transfer, we have to classify whether this transfer, the control is transferring or not. The control is transferring or not. Okay, so if the control is transfer, we say transfer is a sale or not. Transfer of control, control transferred or not. Control here not transferred, and here control is transferred. Here control is transferred. Okay, control is transferred. Control transferred. Now, so if control is not transferred, treat it as a financing arrangement. Treat it as a financing arrangement. Simple. It's not a case of sale and lease back. But if the control is transferred, so control transferred means I had an asset, I sold, control transferred, then only sold, right? See, for a sale and lease back, sale should happen. Sale will happen only when the control is transferred as per IFRS 15. As per IFRS 15, sale will happen only when the control is transferred. Okay, if the sale doesn't happen, can there be a lease back? No, right? So if there is no sale, there is no lease back. Okay, then it is only a financing arrangement. Okay, but if there is a sale, there is a lease back also. So then we have to apply sale and lease back arrangement accounting. Now, tell me, how do we account for accounting? Sale and leaseback accounting. How do we do it off? So we understand, first of all, let me just copy. We do what first of all, we recognize the bank sale proceeds debit. In bank, we recognize sale proceeds debit. We write sale proceeds. Okay, then we de-recognize asset. We de-recognize asset. So to asset credit. Okay, it carrying amount of asset. Then what? We recognize lease liability. And what is the lease liability? What is the amount of lease liability? Present value of future lease payments. Okay, then we recognize ROU asset. Tell me, how do we recognize ROU asset? Is it recognized normally? No. Here it is carrying amount multiplied by lease liability divided by fair value. This is an important thing here. I believe it is very much clear to all of you. Okay, now, so this is how you recognize lease liability now, and the difference is called as P&L, that is gain on sale on lease back, gain or loss on sale on lease back, balancing figure. Okay, this is sale on gain or loss on sale and lease back, a normal accounting. But what if sale price is equals to fair value? Sale is happening at fair value. Okay, which you study at FR level also. But what if, let me write here, what if sale price is greater than fair value? Then what will you do? So in that case, standard says you cannot receive something more than the fair value. If the value of this mobile phone is 100, will I pay 200 to acquire it? No, I cannot. I will definitely not. Okay, then what will happen? Bank sale proceeds lease liability. So here it says whatever excess that you have received, whatever excess that you have received is your financial liability. Credit. Excess of sale proceeds over fair value. Okay, so now then what is the lease liability? It is present value of future lease payments minus financial liability. Okay, this is how you have to account for this one. I believe it is very much clear to all of you. Now, one thing please understand here. Let me take up an example and explain. Let me explain this with the help of example. It will be better. So this example is from this case. So I'll copy this one and I'll write it here and insert columns to the left. Chalo. On 1st January 2008, Zuno enters into a sale and leaseback contract to sell for this much. So this is your sale proceeds. So I'll write here. This is your sale proceeds. Okay. Now that has a carrying amount of 600,000. So I will de-recognize the asset at 600,000. Fair value of 900,000. See, understand? I have sold for this much, but the fair value is this much. So sale is happening at a price above fair value. So the excess of 100,000 is your financial liability. Now, a contract exists, benefits are to be transferred, a price is given, and a performance obligation has been satisfied. Performance obligation satisfied means control is transferred. Control is transferred. Sale is happening since we have to apply sale and leaseback accounting. Okay. Now, Juno will make 10 annual lease payments of this much. Interest rate implicit in the lease is this much. So what is the lease liability? Can you please compute lease liability? It is 115,000 multiplied by 7.772. So your lease 115,000 into 7.72. It is 887800. But out of this 100,000 is your lease, is your financial liability, right? So it comes to minus 100,000. 787800. Okay. Now, so what is your ROU? What is your ROU asset? Is equals to, it is 600,000 multiplied by 787800 divided by fair value is 900,000. Okay, 600,000 divided by 900,000 to 787800. It is equals to 525200. 525200. 525200. Is it clear, everyone? Is it clear, everyone? Done. See, now in the exam, multiple situations can be asked, but what I have given is, I have given you a core formula, or the logic is also clear. Now, according to the logic, you can solve the questions that can come up in the exam. Okay. Generally, in my experience at SBR level, whenever a question of sale and leaseback comes up, this is the question that comes up in the exam. Okay. This type of question, that is sale price is more than fair value. Now, the last topic for the lease is identifying a lease. How will you identify whether the contract is a lease contract or not? How will you identify? So for that, three things should exist. There should be an identified asset. The entity, the lessee should have, let me write here. Who should have the right to direct the use? Lessee should have the right to direct the use. Who should receive right to direct the use? Who should have? Lessee. Who should receive substantially all the economic benefits from use of the asset? Lessee should receive that. Okay, now what is the meaning of identified asset? The asset can be specified in the either explicitly or implicitly. Okay, now then lesser not to have substantive substitution rights. Lesser not to have, okay, lesser not to have the substantive substitution rights. Now that lesser has substantive substitution rights if he has the practical ability to substitute and has economic benefits from substitution. Okay, I have written also what is the meaning of lesser has substantive substitution. Lesser should not have ideally SSR, but I have written how will you identify whether lesser has SSR or not. How will you identify that? So I have written for that also. I highlight important terms. Practical ability is an important term, and economic benefit is an important term. These two things you have to see, and don't forget here it is and. Okay, now right to direct the use means who, how and for what purpose, the asset will be used is determined by lessee. Okay, if how and for what purpose is predetermined. Like for example, this studio, it is predetermined that this studio can be used only and only for taking classes. Okay, so it is predetermined. If how and for what purpose is predetermined, then lessee has the right to operate the asset. Okay, now this is nothing. Economic benefits can be direct or indirect. Okay, it should come from use and not ownership. Okay, now one more point, protective rights. That is restrictions put in by the lessor to protect its interest in the asset. Okay, it does not change the classification to be a lease or not. It does not change. Is that clear, everyone? Come on guys, please tell me. Okay, how and for what purpose is important. Highlight right to operate. Highlight not ownership. Highlight. So with this, we come to an end of the chapter of lease. And now we have to start financial instruments. I'll take around 1 hour. Financial instruments is a major important chapter now. Okay, financial instruments will take around 1 hour. Tell me, do you need a break or can we continue? Do you need a break or can we continue? Do you need a break or we can continue? चलो ठीक है, understood your point, giving you, because financial instruments I don't want you to be like that. No, I want you to give your full. Okay, so I'm giving you a break of 15 minutes. because financial instruments is a quite an important chapter, and I will take some time. I will go into the depth of it. Okay. Hello, guys. Can we resume back? Can we resume back and complete the one of the most important chapter, that is financial instruments? Come on, guys, please tell me. Chalo, let us study financial instruments. Okay, so in the chapter of financial instruments, we have to study primarily financial asset, financial liability, equity, and compound financial instruments. Okay, these are the four things which you have to study primarily. But apart from this, we are also required to study something called as what we say it as this derivative and hedge accounting. Derivative and hedge accounting. Okay, we'll study. So I believe many students have this challenge of hedge accounting, right? So I have taken up an example of hedge accounting. I have taken up an example of hedge accounting, explained it step by step. Similarly, for cash flow hedge also, I have taken up an example and explained it step by step so that you understand the entire concept in easy manner. Okay, chalo, let us start. Now, financial asset. Tell me, what are the types of financial asset? Financial asset can be at amortized cost method. Financial asset can be at FVT OCI. Financial asset can be at FVTPL. Right now, for financial liability is generally at amortized cost method, but there are few exceptions. Where it is measured at FVTPL. Okay, and what are those exceptions? Can you please tell me? One of this, that is derivative financial liability. Another is contingent consideration. Right, these two are the, another is financial guarantee, but that's not in our syllabus, so let's ignore that off. Okay, now coming to equity, there is no classification. Equity is always measured at issue proceeds value, that's all. Okay, compound financial instrument, initially it is split. Okay, again no classification. Now coming to initial measurement, so FA at ACM. Okay, or for initial measurement of FA, I'll refer below. For financial liability, initial measurement at fair value, that is net amount received. Okay, subsequent measurement at amortized cost method. Okay, now issue proceeds. For equity, initially it is measured at issue proceeds value. Subsequently, it remains constant. It is not remeasured. Okay, now compound financial instrument, it is done, we do split accounting. Okay, now for FL part, we measure at amortized cost method, and for equity part, it remains constant. Okay, chalo. Now we have to study. See, the whole objective of this comparative analysis is to give you a overview of what exactly is financial asset, financial liability, equity, and compound financial instruments. Now we'll go into the depth of each topic one by one and study that. So first of all, we are going into the chapter of financial assets. financial assets. Okay, now financial assets initial measurement. So there are three types of financial assets: ACM, FVT OCI, or FVT P and L. Now tell me, how do we classify? How do we classify whether the financial asset is under ACM or FVT OCI or FVT P and L? How do we classify that? Can you please tell me? By using how to classify. Let me write that. How to classify. How to classify. Using business model test and contractual cash flow test. Now what does this two test say? Business model test can be held to maturity or held to maturity but can be sold, and third is held for trading. Now contractual cash flow test means principal and interest, only principal, solely principal and interest on specified dates and no other rights. Okay, now if business model test is held to maturity plus contractual cash flow test pass, then it is at amortized cost method. If a business model is held to maturity but can be sold plus CCFT pass, it is at FVT OCI. Okay, if it is any others, then it is at FVTPL. So this is how we classify the financial asset under three classifications. Okay, now initial measurement. When FA is at amortized cost method, how do we measure? So FA, measurement of FA. Let me write here, measurement of FA. Measurement of financial assets. Initially at purchase price plus add transaction costs less any processing fees received. But what will be the case in FA at FBTOCI? So I'll write here same as FA at ACM. Okay, but if FA is at FBT P&L, then we recognize initially at purchase price only, and transaction costs, if any, is recognized in P and L. I believe it is clear to all of you. Now subsequently for FA at ACM, you calculate effective interest rate. Basically you amortize using EIR. Now same as FA at ACM. Okay, now fair value gain loss. Okay, no amortization here. Okay, now finance income is recognized using effective interest rate. Finance income is recognized, again same thing, I'll write here same thing. Now but FA at FVT P&L, finance income is not recognized using coupon rate. Whatever amount we receive is our finance income. Now fair value gain loss, no fair value gain or loss. No fair value gain loss under FA at ACM, but here the fair value gain or loss is recognized in other comprehensive income, and here the fair value gain loss is recognized in P and L. But as you know, OCI is a temporary account. So I will tell here One important part. Just a minute. Insert page break. One important part which you need to take care here is any cumulative gain or loss recognized in OCI is transferred to P and L when the FA is settled or sold, whatever. Now you will ask me, sir, can you please explain this with the help of an example? Tell me, do you want me to take up an example for this one? Okay, here transaction costs and processing fees is recognized in P&L both. ठीक है? Na, Mr. I'm not able to say your name. So it's not reclassified to RE, no. P&L. P&L. Okay. Chalo, let me take up an example for this one. Okay. Now, though it's a very lengthy example, so I'll not be solving this example entirely, but yes, I'll discuss this. Okay. See, I have brought all the cases with you guys. I have brought all the cases. Okay. Now understand. On 1st April 2021, VJ Limited bought this much bonds for 95,000. So this is the purchase price. 95,000 is your purchase price. Okay. Incurred transaction cost of 2,000. Okay. Now the fair value of the bond at each year end is given. Effective interest rate is also given. Effective interest rate is given. Okay. Coupon rate is 5%. Coupon rate is 5%. Now question is asking you, first of all, is the contractual cash flow test passing? So contractual cash flow test says principal and interest on specified dates. Is it happening here? Yes. Principal and interest is being paid on specified dates. So contractual cash flow test passes. Now there are multiple business model given. Let us analyze and account for it accordingly. Okay. Now case A, business model is to hold bonds till redemption date, means hold till maturity, means amortized cost method. So tell me what value will we recognize initially? So initially at purchase price plus transaction cost. Purchase price plus transaction cost 97,000. Right, initially 97,000. Now we record finance income using effective interest rate of 8%. We recognize finance income at the rate of effective interest rate 8% of 97,000. Now we collect the contractual cash flows. 5% is applied on the face value. 1,000 number of bonds multiplied by face value of 100 is 100,000 multiplied by 5% is 500,000. Sorry, 5,000. Is the contractual cash flow that we receive, and here we arrive at the closing balance. So this is how we account for under FA at ACM. I believe it is very much clear to all of you. Now if it is now this the same question, if you solve under FBT OCI, if the same question you solve under FBT OCI, again 97,000 finance income at effective interest rate, you collect the contractual cash flows. Then, but since it is FBT OCI, you have to remeasure to fair value at each reporting date. So I have recorded this at fair value 110,000, and fair value gain or loss is going to other comprehensive income. Okay. Now this closing balance becomes the opening balance. Now the challenge here is, this part is the main challenge. What a student does here is they will calculate 8% on the opening. No, you are not required to do it. No. You are required to calculate the finance income as per the amortized cost method. See 7981. The amount will remain the same. The amount of finance income will remain the same. Okay. So the crux here I can write here. The crux I want to write. If I have to write the crux here. crux is amount of finance income under FBT OCI and finance income under ACM will be same. Important part, very important point. Okay. Now, part C, case C is FVT OCI when the FVT OCI assets are sold. Case C is when the financial asset as FVT OCI is sold. So now let's suppose at the end of second year it is sold. Then what happens? I have said this point. Please come here. Any cumulative gain or loss recognized in OCI is transferred to P&L when FA is settled or sold. So let's suppose FA is sold here. So tell me what is the on this date on the date of sale, that is 31st March, that is year end 2. What is the cumulative gain in other comprehensive income? Tell me guys. So first year it was 10240 gain. Second year it is a loss of 8981 loss. So it what is the net amount? 10240 minus 8981 is 1259 gain. Okay, so therefore a gain of 1259 is transferred from OCI to P&L. This again is the crux. Very important point. I hope it is clear to all of you. Okay, now case D is particularly a case of FVT P&L. It is a case of FVT P&L. Now what happens here? Please see, under FA at FVT P&L, we record the asset at the purchase price, transaction cost goes to P&L. We record the contractual cash flows that we receive, and whatever amount we receive is our finance income. We record the asset at fair value, and the fair value gain or loss goes to P&L. Simple. Okay, now moving on to a query that is coming up here. How did we recognize gain or loss in other comprehensive income? See here, opening is purchase price plus transaction costs. Then finance income, keep on adding, keep on calculating. So opening is 97,000, finance income of 7760. Then we collected contractual cash flows of 5,000. What is the balance? Tell me. What is the balance? 99760. But what is the fair value at year end 1? 110,000 minus 110,000. This gives you a fair value gain of 10240. So fair value gain of 10240 will be recognized in other comprehensive income. Clear now? Is it clear now? Chalo. Now moving on to the next topic. Clear? Investment in equity instruments. Now tell me, let's suppose Now, even if I have an intention to hold the equity instruments till maturity, will it classify, will it satisfy, or will it pass the contractual cash flow test? No, because from equity instruments we get dividend and there is no specified dates for the dividend, right? So FVT P&L is the by default classification, is FVT P&L. But if the question specifically mentions that the entity has selected the irrevocable option or election, okay, so it is an irrevocable option at initial recognition. Okay, now, so initial measurement is at purchase price. Any transaction cost is recognized in P&L. Now, subsequent measurement is at P&L, fair value gain loss. Okay. Dividend income in P&L. Now, coming to here, if we follow FBT OCI, then purchase price add transaction costs is the initial value. Okay, now the fair value gain or loss is recognized in other comprehensive income. Okay, now dividend income anyways is recognized in P&L only. Okay, chalo. Now the example. Chalo, let us take up an example. On 1st April 2001, VJ Limited purchased 1000 shares of Reliance at a price of $75 per share, incurring cost of 500. So what will be the initial value here? Here it will be 1000 into 75 is 75,000, and here it will be 75,000 plus 500. Okay, now right here again transaction costs of 500 to P&L. Okay, now subsequent measurement. So what is the subsequent fair value? Fair value is 90. So year end value is 90,000. So what is the fair value gain? 15,000 P&L. So what is the, again, fair value is 90,000. Fair value gain is 14,000, 75,500, right? It is 75,500. Gain is 14,500, which will be recognized in other comprehensive income. Dividend income, there is no dividend income. If it is there, it will be recognized in P&L. Is it clear, everyone? Chalo. Coming to impairment of financial asset. Okay, now in this impairment chapter, the major important issue is computation of finance income, which I'll discuss. But first of all, please understand, Mr. Pradyuman and everyone who is trying to deviate from the topic and discussing all other points, I request all of you not to deviate from the topic. Okay, I request all of you not to deviate from the topic. If you have to discuss anything else apart from this important topic which I'm discussing here, you can very well leave the class and enjoy. Now, coming to impairment of financial assets. So, financial assets, as we know, are of three types particularly. Okay, FA at ACM, FA at FVT OCI, FA at FVT P&L. Okay, now please understand, since FA at FVT P&L, it is already at fair value and the impact is going in P&L. So there is no further need of impairment. Okay, so let me strike it off. Let me strike it off. Okay, now investment in equity instruments. Investment in equity instruments is at fair value, but the impact is going in OCI. But the impact is going in OCI. And standard clearly says that if the investment in equity instruments is at FVT OCI, it cannot be recycled back to P and L. It cannot be recycled back to P and L. No, it cannot be done, right? So anyways, this impairment loss from OCI to P&L recycling cannot be done. So this investment in equity instruments at FVT OCI cannot be impaired. So I am striking it off. Okay, chalo. Now what we have to impair is FA at ACM and FA at FVT OCI. Now this, the journal entry for the impairment of this is P and L debit to FA. We have to reduce FA and take the impact to P and L. We have to reduce FA and take the impact to P and L. Now since for FA at FVT OCI the asset is already at fair value, do we need to reduce the FA? Do we need to reduce the FA any further? No, we are not required. We are not required to okay, we are not required to reduce the value of FA. Okay, rather what we will do is the impact has to go to P and L. Yes, the impact has to go to P and L. Yes, P and L debit to what? We cannot reduce FA because FA is already at fair value. We cannot reduce FA. The FA is already at fair value. So it is to OCI. We will recycle from OCI to P and L. Okay. These two will not be impaired. These two will not be impaired. Getting my point? Let me write here. No impairment. Oh, then no impairment. Okay, chalo. How to compute finance income? So please understand, there are two types of impairment of FA. One is 12-month ECL and another is lifetime ECL. So if FA is impaired during the year and it is 12-month ECL, okay, then finance income of next year will be on gross FA. Now what is the meaning of gross FA? What is the meaning of gross FA? Means it is not netted off about, which means it is not netted off of impairment. Yes, they can definitely do it. Then why do you think, Pradyuman, am I going into the depth of small topics? Because I know a student can miss out on these small topics, and that's the reason I am going to the depth. If FA is impaired during the year and it is a lifetime ECL, then also FA for the finance income for the next year will be on gross FA. Okay, now finances is impaired, lifetime ECL. Reason is FA is credit impaired. FA is credit impaired. FA is credit impaired. Then finance income of next year will be on net FA. That is FA net of impairment loss. Net of impairment loss. Okay. Now comes the question. under 12-month ECL, how will we compute the value of ECL, and under lifetime ECL, how will we compute the value of ECL? What will be the values of impairment under these two methods? Okay, present value of expected loss multiplied by probability of loss in next 12 months is your 12-month ECL. But then what is lifetime ECL? Then it is 100%. Okay, so this is what makes the difference. Here you have to multiply with probability amount. Here you are not required to multiply with probability amount. That's what makes the difference. Okay, so please keep in mind this thing. Now, so with this, our financial asset is completed. Now we are moving on to the next topic, that is financial liability. Now, financial liability initially is measured at net amount received. Net amount received. Subsequently, it is measured at amortized cost method. Now, what is amortized cost method? What is amortized cost method? So it is opening financial liability plus finance costs. I believe you have studied something, somewhere you have studied this part, minus contractual cash flows is equals to closing financial liability. Finance costs is recognized in P&L financing category. Financing category. Okay. Now, further. De-recognition of financial liability, a very important topic from an exam perspective. Okay, very important topic. Now, though it is not, it was never included as part of in that depth in your syllabus. They have just given the theory of it. But what I have done is I have taken up an example. This example was not in your syllabus, but I have taken up the example because I believe you never know, ACCA can test de-recognition of financial liability as in detail in the exam. So I will be discussing this example in depth. Okay, I will be discussing this example in depth, and I request all of you to follow me and understand things properly. It might be a little bit a complex example, but very important from an exam point of view. Okay, chalo. Types of de-recognition of financial liability. There are two types. One is modification of financial liability, and another is extinguishment of financial liability. Extinguishment of financial liability. Okay, now, but comes the question, the more important question: how will you check whether this is a case of modification or extinguishment? How will you check that? So for that, you need to apply certain steps. Step number 1. Calculate carrying amount of financial liability. Step 2. Calculate revised financial liability. Now, revised financial liability will be present value of revised cash flows, but at original discount rate. Okay. Step 3 is calculate change percentage. And how will you calculate change percentage? It is revised financial liability minus carrying amount of financial liability divided by carrying amount of financial liability. Okay, so this is how you calculate the change percentage. This is how you calculate the change percentage. Step 4, if okay, if change percentage is less than 10%, then you have to apply modification accounting. But if change percent is 10% or more, then you have to apply extinguishment accounting. Okay, now please keep in mind 10% or more, less than 10%, less than 10%. Now, what will be the accounting treatment under extinguishment financial liability or modification? We will discuss this. But first of all, from this question, can you identify whether it is a case of modification accounting or extinguishment accounting? Come on guys, tell me, can you identify from this question whether it is a modification accounting or extinguishment accounting? Chalo, let us identify. So I'm writing here, how identification as modification or extinguishment. Chalo. So first of all, for that we need, let me prepare steps, copy, paste. Step 1, what is the carrying amount of financial liability? Can you please tell me guys? Now we have borrowed 500,000 on 1st January 2007. The original terms was interest rate, that is coupon rate of this much. For your ease of understanding, I am making it a coupon rate of 11%. Repayment of principal in 5 equal installments means 100,000 every year. Payment of interest on accrual basis annually. Upfront processing fees is this much. Effective interest rate is this much. So we will recognize the loan initially. We will recognize the loan initially at 500,000 minus 5870. That is 494 initially at 494130. Then at year end 1, what is the value? 494130 plus finance cost at the rate of 11.5%, right? That is effective interest rate into 0.115. That is 56825. 56825. Now we will receive the contractual cash flows. What? That is first of all equal installments of the principal, that is 100,000. Then interest of 500,000 multiplied by 11% is 55,000 interest. So what is the amount? 494,130 plus 56825 minus 150,000 is 400,955. Sorry, 395,955. I have done some calculation. 395,955. Okay, then year end 2, the value is 395,955 plus finance cost is how much? 11.5%. 395,955 into 0.115 is 45535. 45535. Then what does the question say again? On 31st December 20XT means at year end 2, second coupon payment was made. After the second coupon payment was made, coupon payment means interest. Okay, VJ Limited approached the bank citing liquidity issues in meeting the cash flows required for immediate principal installments. Oh, so principal payment for the second year was not done. Means I will pay interest of 44,000. So what is the amount? 395,955 plus 45535 minus 44,000 is 397,490. So this is the carrying amount of financial liability. Is that clear? Is that clear, everyone? On 31 December 20x2. Right now we need to find step 2 is revised financial liability. Revised financial liability, which is the present value but at original discount rate. Okay, now so what are the revised terms and conditions? Repayment of the outstanding principal. What is the outstanding principal? Total principal was 5 lakh. 1 lakh is already repaid, 4 lakh is remaining at the end of 10th year. Present value of principal is 400,000 multiplied by present value interest factor 11.5 original discount rate, comma 10 years. Okay, now present value of interest. What is the interest payment? Interest payment is how much? 15%. 15% of 4 lakh is how much? 4 lakh into 0.15 is 60,000. So just do one thing right here. Present value of revised cash flows including transaction costs. Okay, now present value of interest is 60,000 multiplied by this. We have to do annuity factor. Present value annuity factor 11.5% comma 10 years. Okay, and then transaction costs of 1800. So what is the total? Can you please help me with the total amount? Can anyone please help me with the total amount? Something I will expect from you guys, definitely. Basic calculations I will definitely expect from you guys. How was at year end 1, at the beginning of second year, what is the outstanding principal? 4 lakh. 4 lakh multiplied by 11% is 44,000. Okay, now what is the amount? 1.115 divided 1 2 3 4 5 6 7 8 9 10 337, that is 0.337, that is GT 5.6768, 5.768. 400,000 into 0.337 is 134,800. 60,000 into 5.768, 346,080, 346,080. So what is the present revised financial liability? 134,800 plus 346,080 plus 1,800 is 482,680. 482,680. Is the calculation correct? Logically I am correct, I know, but calculation part, if you can check, it will be a help for me. Step 3 is change percentage. Is how much? 482,680 minus 397,490 divided by 397,490. 482,680 minus 397,490 divided by 397,490 is 21.43%. Now, so hence it is extinguishment accounting. Since it is more than 10%, extinguishment accounting will apply. Tell me guys, is that clear everyone? Identification, is it clear to everyone? Is the identification clear to everyone? Is the identification clear to everyone? Is the identification clear to everyone? See guys, I have already done all the accounting in depth. All the accounting in depth. Now VJ Limited approached the bank. Okay, done. So now we have to apply extinguishment accounting. So what happens under extinguishment accounting? What happens under extinguishment accounting? Let me write that here. Under extinguishment accounting, you de-recognize old FL. You de-recognize old FL. You recognize new FL. New FL at present value of revised cash flows at revised discount rate. Okay, difference to P&L. Transaction costs to P&L. So basically standard says that it is like elimination of old FL and creation of new FL. Okay, so de-recognize old FL. So here what will I do? Here we have to apply extinguishment accounting. De-recognize, let me copy that. Old FL at 397490. Now recognize new FL at present value of revised cash flows. So these are the revised cash flows. We have to calculate the present value at revised discount rate. What is revised discount rate? 15%. 15%. So calculate. Can you calculate the present value, guys? Can you calculate the present value for me? Therefore, present value will be equals to 400,000. If you calculate it, you will get 400,000. Okay. Now, difference is how much? Difference is how much? 400,000 minus 397,490 is equals to how much? 400,000 minus 397,490 is 2510 will go to P and L. Transaction costs of 1800 will also go to P and L. So this is how you will do the accounting treatment of extinguishment liability. Is that clear, everyone? Is that clear, everyone? Now the reason we do not consider transaction cost in this extinguishment accounting is we assume that this transaction cost was pertaining to the old FL. Old FL is discontinued, so any transaction cost incurred on old FL has to be transferred to P&L immediately. Okay. Clear, Vaishnavi? Is that clear, Vaishnavi? Chalo. Now, what about modification of FL? What about modification of FL? It's loss, na? Your liability increased. Your FL was this much. Your FL now is this much. Your liability increased is a loss. and this loss in P&L will be recognized under financing category. Now, under modification accounting, we say it is deemed as continuation. It is deemed as continuation of old FL. Now, hence what we do is we adjust transaction costs with carrying amount of old FL, compute new EIR and do accounting accordingly. Compute new IR and do amortize accordingly. This is what you do in modification of financial liability. Is that clear, everyone? The derecognition of financial liability part. Come on, guys, tell me. Is it clear, everyone? So we have studied fairly FA, FL. Now we are here studying compound financial instrument. But before that, please tell me if it is clear to all of you till here. Chalo, done. Compound financial instrument. What is the meaning of compound financial instrument? An instrument which has the features or characteristics of equity and FL both. Then initial measurement. How will we do initial measurement? Split accounting. Split the instrument into FL and equity instrument. But before that, we need to understand few things. Identification part. So principal, interest or dividends and conversion right. So please understand, conversion rights is always equity. Interest or dividend, just see whether it is mandatory to pay or not. If it is mandatory, it is financial liability. If it is discretionary, means it can be avoidable. Then it is equity. Now, for principal, if it is redeemable, it is financial liability. If it is irredeemable, it is equity. But if it is convertible, then for convertible part, you have to see, sorry, my bad. If it is convertible, for convertible part, you have to see if it is compulsorily convertible. If it is compulsorily convertible to fixed number of equity shares, then it is equity. Rest all financial liability. Is that clear, everyone? Now, so what should be the value of split accounting? Value of FL is present value of cash flows, contractual cash flows for FL elements. It can be principal, it can be interest, can be both. Okay. For FL elements at market rate of interest without conversion rights. Okay, this is the value of financial liability. Now adjust this with issue proceeds, and the differential value of equity is issue proceeds minus value of FL. I believe it is clear to all of you. I believe it is clear to all of you. So this is the initial measurement. This is the initial measurement. Now, what about subsequent measurement? For FL, amortize, that is opening FL plus finance costs minus cash flows. For equity, it remains constant. It remains constant. Okay. Now, what happens on the settlement date? On the settlement date, if cash has to be given, then FL account debit to bank, and if we have recognized any equity will be debited and transferred to retained earnings. Okay, but if equity shares are to be given, then FL account debit, equity account debit, to equity capital credit, number of shares multiplied by face value per share, to securities, to our share premium, credit what amount? Balancing figure. Whatever is the amount will go to securities premium, share premium, balancing figure. Is that clear, everyone? Now, someone has a doubt. Sir, can you explain FL measurement? When is it zero coupon bond? Can you give scenario when they ask like this? See, for a zero coupon bond, again, the amount that we receive today is the value at which I will recognize. I will have to compute effective interest rate. Using the effective interest rate, I will just unwind. There will be no cash flows. I will just keep on unwinding. There will be no cash flows. Simple. Still, if you want me to take up, I can take it up, but there can be multiple scenarios like this. But first of all, let me complete compound financial instrument, then I can go to that. But first of all, let us complete this compound financial instrument now. Now, I have an example for compound financial instrument. Okay, chalo, let us do this accounting. Copy. Come on. In this case, tell me, the company issued 10 million 5% convertible loan notes on this month on 1st December 31st December 2003. It will either be repaid at par or convertible into shares. Optionally convertible. It is optionally convertible. Hence, financial liability. optionally convertible, hence financial liability. Then what about interest? Interest has to be paid. Okay, so interest mandatory, hence financial liability. So only thing equity is this one. Fine, okay. So now what will be the present value of principal? What is the amount of principal? Come on, tell me. 10 million. 10 million for 3 years. 3 years. Okay, 1, 2, 3. Okay, 10 million multiplied by 0.794. 0.794. Now present value of interest is 10 million and interest is 10 million multiplied by 5%. 10 into 0.05 is 0.5. Is 0.5 million into now you have to take the sum of these. For interest it is paid every year, so I have to take the sum of these three, which is 0.926 plus 0.857 plus 0.794, that is 2.577. 2.577. So now tell me the amounts. It is 7.94. It is equals to 0.5, 1.29. Okay, is equals to 7.94 plus 1.29 is 9.23. Okay, now so what is the issue proceeds? 10. What is the value of FL? 9.23. So what is the value of equity? Minus 10 is 0.77. Okay, now you will have to amortize. So equity will remain constant at 0.77 only, but for FL you have to amortize. That is finance costs you have to record. Okay, I believe you can record finance cost for settlement. The question is not giving you the data, so settlement accounting anyways we will not be able to do it off, but I believe finance cost you can very well recognize on your own. That's not a challenge at all, I believe. Right now record finance costs, pay contractual cash flows. Okay, now coming on to the derivative. Now what is the meaning of derivative? Can you please tell me, guys? Come on. What is the meaning of derivative? Come on, guys, can you please tell me the meaning of derivative? Can anyone tell me the meaning of derivative, guys? It's been 5 hours since we have started the marathon, and I think we are already midway, and we will take around 3 to 4 hours more and complete this revision. Right, derivative is an instrument with nil or low initial investment, derives its value from underlying, okay, and is settled at a future date. Okay, now can you give examples? It can be forwards, futures, call options, okay, etc. Now what is the accounting treatment? So accounting treatment is P and L. FVT P and L. Okay, so what you have to do, how? So basically you have to compute fair value at each reporting date. You have to compute fair value at each reporting date and transfer gain or loss to P and L. To P and L. How to compute fair value we will discuss, don't worry. Okay, so today I'll be taking example of hedge accounting. In the hedge accounting, the hedge instrument is nothing but derivative. In the hedge accounting, hedge instrument is nothing but the derivative. So I will show how exactly to compute the fair value. Don't worry at all about that. Okay, now chalo. This is derivative done. Now coming to hedge accounting. What is the meaning of hedge accounting? Can you give me the meaning? Hedge accounting, hedge is a method of managing risks. Hedge is a method of managing risks by designating hedge instrument, by designating a hedge instrument so that gain or loss on hedged item is offset by gain on hedge instrument. This is the meaning of hedge. This is the meaning of hedge. Now there are three types of hedge. Type 1 is fair value hedge. Type 2 is cash flow hedge. Type 3 is net investment hedge. Now, before that, before I start hedge accounting, I request all of you, will you do something for me? There is a topic called as hedge documentation. Is it important from exam? Yes, but it's a theoretical topic. Nothing. I don't want to explain anything in this one. I believe you can study this on your own. Hedge documentation. Okay. Now, types of hedge. So now I'll take up each and every type of hedge and explain it off. Okay, chalo. First is accounting of fair value hedge. Accounting of fair value hedge. Under fair value hedge, what happens? Please understand. Few important points. There is a risk of decrease in fair value. There is a risk of decrease in fair value. Now, in this case, hedged item and hedged instrument, both hedged item and hedged instrument is measured at FVTPL. Both is measured at FVTPL. Okay, now let me explain this with the help of example. Okay, chalo. Better to take it to the next page. Insert page break. Now, example. Please see. There's an inventory of 1000 tons of copper and the cost of the inventory is $5.2 million. The risk is the price of copper will fall before they sell it. Okay, now hedge instrument is on 1st January 2020. Okay, entity enter into a 12-month forward contract. This is a derivative. This is a derivative to sell the inventories. Okay, at a price of $5,200 per ton. At a price of $5,200 per ton. So now, whatever is the price in the future, now I will sell at 5,200 only. I have fixed. Okay, now designates, the company designates the futures contract as a fair value hedge of the price risk of the inventory. Okay, now fair value of inventory at each reporting date is given. So come here, this is the contract date, and this 31st December, it's a 12-month forward contract, 12-month forward contract. Okay, so this is the contract date, this is the settlement date, this is the settlement date. Okay, now on contract date, hedge item inventory has a cost of this much. Hedge instrument is contract to sell inventory in the forward market at this price. Will we pass any accounting treatment on the contract date? No, no, no. Reporting date come up. I have to settle the contract on this date, but before these two dates, in between these two dates, a reporting date came up. On the reporting date, the fair value of the inventory is 4900 per ton. So now tell me what will happen. What will happen? In the inventory was having a cost of 55.2 million. The inventory has a fair, inventory was having a cost, understand, inventory was having a cost $5.2 million. Fair value is $4.9 million. So hence loss on inventory is 0.3 million. It will be recognized in P&L. Is this part clear? Come on guys, please tell me. I am going slow. Tell me, is this part clear? Now coming to hedged instrument. I have entered into contract to sell at 5200. Price decreased to 4900. So price decreased to 49, but still I will be able to sell at 5200. So it's a gain, it's a gain, it's a gain, right? Think of it like this. You have entered into a contract with your friend to sell something at 5200. The price in the market falls to 4900. You are like, oh, saved, bach gaye. If I would have not entered into this contract, I would have been required to sell at 4900. There was a loss, there could have been a loss. I got saved from the loss. Savings of loss is also a profit. Okay, so in the hedge contract, hedge instrument, there is a gain on the derivative 0.3. This will be recognized in P and L. So in the P and L, what is the net impact? Loss on the hedge item is offset against the gain on the hedge instrument, right? Net impact in the P and L is 0. Now in SOFP, you will recognize the inventory of 4.9 and derivative asset of 3.3. Is that clear, everyone? Come on guys, tell me. Is that clear, everyone? Chalo. On the settlement date, the price further fall down to 4.4800. So on the inventory, what is the cost now? Cost is $4.9 million. Fair value now is $4.8 million. So hence there is a loss on inventory of 0.1 million recognized in P&L. Now hedge instrument, there is a gain on derivative of 0.1 million recognized in P&L. Net impact in P&L is nil. Right now in inventory, you will recognize at 4.8 million, derivative asset of 0.4 million. How come 0.4? 0.3 here. Let me highlight in red. 0.1 here. Hence a derivative asset of 0.4 million. Is that clear, everyone? Is that clear, everyone? So what will happen? This loss of 0.4, say inventory was having a cost of 5.2. Now the inventory is having a 4.8 million value. So there is a loss of 4.8, which I will recover from the derivative asset, Okay, so let me write here. This loss of inventory, loss in fair value of inventory will be recovered through derivative asset. Okay, on this settlement date, on the settlement date. ठीक है, चलो coming to cash flow hedge. Okay, now Karma is asking, sir, on the reporting date, this one, if the fair value would have been 5200, then if the fair value would have been 5200, okay, cost was, inventory was having a cost of 5.2, fair value is 5.2, there is no loss on inventory. Now I have entered into a contract to sell the inventory at 5.2 million, fair value is also 5.2 million, no gain on, so there is no gain, no loss, no gain, no loss, no loss on the hedge item, no gain on the hedge instrument. Coming to cash flow hedge, now what is happening in the cash flow hedge? There is a risk of decreased cash flows, decreased cash inflows, or increased cash outflows. Okay, then how will you account for it? Hedged item is accounted for under respective standard. Hedged item we don't touch. It is accounted for under the respective standard. But hedge instrument is okay. So fair value gain or loss on hedge instrument is recognized in other comprehensive income and accumulated in cash flow hedge reserve on settlement. This cash flow hedge reserve is transferred to P&L. Hedge instrument is recognized in OCI, then accumulated in cash flow hedge reserve. On settlement, it is transferred to P&L. Okay, now come here. See, in the hedge instrument, whatever was the gain I recognized in other comprehensive income and accumulated in cash flow hedge reserve. Again, on the settlement date, whatever is the gain on the hedge instrument, I am recognizing in OCI and accumulating in cash flow hedge reserve. Now, since it is the settlement date, what is the cumulative balance? 0.2, 0.1, total cumulative balance is 0.3 million. It will be transferred to P&L. Okay. Now, so with this, we complete our hedge accounting as well. Now we have to move on to the next chapter, that is grants. Now, I'd like to take a 5 minutes small break so that you can cool down yourself, and then we'll study grants and revenue and then take a break. Grants and revenue, and then we'll take a break again. Yes, 5-minute break we will have. Come on guys, can we resume back? Can we resume back guys? Come on, please tell me. Chalo. Accounting for government grant. Now tell me, when do we account for government grants? When is it recognized? When is the grant recognized in financial statements? When is the grant recognized in financial statements? When the entity is reasonably certain or has a reasonable assurance that the conditions, grant conditions, will be complied and grant will be received, then they have to recognize. Okay, now what about the grant related to income on the date of receipt? Sorry, on the date of receipt of grant, we recognize bank account debit, bank, credit, deferred grant income. Okay, then subsequently recognize grant income over grant period in the ratio of compliance costs or straight line method as the case may be, or straight line method as the case may be, and the general entry will be debit deferred grant income, credit grant income in P and L operating category. Okay, now done this one. Okay, now what about grant related to asset? Okay, if we have received the grant for asset, then what will happen? On the date of receipt and subsequently on the date of receipt, if it is a grant for asset, we have two methods. One is gross method and another is net method. Okay, now under gross method, the accounting treatment is this one only, because the asset, understand I'm writing here, under gross method, asset and grant is accounted separately. Okay, asset and grant is accounted separately. So grant, we are doing the grant accounting. Okay, now subsequently what will happen? Grant income will be recognized over the grant period in the ratio of depreciation costs. Okay, now But if the grant is being recognized under net method, then what will happen? Initially, under net method, asset and grant is accounted in net method, in net basis. Okay, on the date of receipt of grant, you will write bank account debit to asset. You will reduce the value of the asset. You will reduce the value of the asset by the amount of grant. Subsequently, recognize, or I can say depreciate reduced value of asset over its useful life. Debit depreciation, credit asset. Depreciation will be recognized in P&L operating category. Done. Repayment of grant related to income. So now if the grant related to income has to be repaid, so repay from firstly from balance of deferred grant income, any excess from P&L, and the journal entry will be deferred grant income account debit P&L, credit grant payable, or if you have already paid, bank. Yes, where in the entire SBR exam, whenever you are writing, this thing will go to P&L. In the bracket, you have to write which category. In the bracket, which you have to write which category. And for your ease, see, I have already done that work for you guys. You want to see? I'll just show it to you. Just hold on a minute. Or just a minute. Ruko. I have already done that work for you guys. Just a minute, so that you should not struggle somewhere like what should be the category of this, because in the entire book the clarification is not given. Okay, they have just given the general principles, but they have not given the detailed clarification. So I have done that work for you guys, need not worry at all. Just hold on a minute, let me show it to you guys. Though I prepared these notes for my regular batch students, but okay, ठीक है, I'll open it for all. Can you see these notes? See here, please come. See, for each standard by standard, what are the P&L impact that can come up? We have already analyzed for each standard and analyzed which category will it go. I believe this will be of great help for all of you. So don't worry at all. Now, so repayment of grant related to income is already done. Then repayment of grant for asset. So I have an example for this one. Yes, I'll say, don't worry. Now, repayment of grant for the asset. So now for the grant for the asset, what will happen here is let us discuss the accounting treatment with the help of example itself. Grant, no grant impact. So understand what happens on 1st January 2006. On 1st January 2006, Garden Bucks Company received $30,000 government grant relating to the equipment which cost 90,000. So cost of the asset is 90,000. Okay, now received a grant of 30,000. So if we consider grant, we received a grant of 30,000. Okay, now so no grant, I am not considering grant. Okay, net cost is 60,000 here, and net cost here is 90,000 only. Okay, so the impact is 30,000. Okay, now what is the depreciation? Depreciation for 20x6, life is useful life is 6 years. Useful life is 6 years. So the depreciation will be 10,000. Okay, depreciation will be 15,000. Now, so what is the carrying amount? What is the carrying amount on 1st January 20x7? It is 50,000. Okay, so it says on 1st January 2007, when the equipment had a carrying amount of 50,000, its use was changed so that it no longer is used in accordance with the grant. So the use is changed, and accordingly the grant becomes repayable. So here what is the carrying amount? 75,000. So now what will have an impact? Understand. Now on 1st January 2007, the grant becomes repayable. So how will you do the accounting? So for that, you will have to understand, you will have to increase the value of the asset by 25,000, right? You will have to increase the depreciation of the current year by 5,000. So journal entry will be debit depreciation by 5,000, debit asset by 25,000, and credit grant payable by 30,000. I will share all the notes, don't worry at all. I'll share all the notes. The notes, but you'll find the notes in the Telegram group, the link of which I've already shared here. Okay, chalo, done. So this completes our chapter of grant. Now moving on to the next chapter of revenue. Just if you want to look at it for 1 more minute, you can do that. Please understand what is the impact in the current year. If there was a grant, the depreciation was 10,000. If there is no grant, depreciation is 15,000. So depreciation has to be increased by 5,000. Right now, If there is a grant, the value of the asset is 50,000. If there is no grant, the value of the asset is 75,000. What is the value of the asset should increase by 25,000. So asset account debit 25, depreciation account debit 5, credit grant payable. So whenever a grant for an asset for which you have used net method is repayable, then you calculate how, what is the situation with grant, what is the situation without grant, calculate the impact, and this is how you do the accounting. Guys, please don't ask me this question. Can this chapter be asked? Can that chapter not be asked? I can't say that. In SBR, anything can come from anywhere in the exam. But still, on the basis of past paper practice, I have already analyzed a list of important topics that can come up in the exam and already made a video of it, which you can go and watch. Chapter number 8, revenue, an important chapter again. Okay, chalo. Revenue. 5-step model. What are the 5-step model? Can you please tell me? Step 1. Chalo, let me make a table. I believe when we insert table, it becomes more easy for us to recall also, right? Tabular format is better presentation. In my opinion, yes, right? Step 1, step 2, step 3, step 4, step 5. Step 1 is identify contract. Step 2 is identify performance obligation. Step 3 is determine transaction price. Step 4 is allocate transaction price to each performance obligation. And then is recognize revenue for us and when each performance obligation is satisfied. Thanks, Ramya. Thanks, Ramya. It feels good when someone appreciates your effort. Okay, now how to identify whether the contract exists or not? So there are 5 conditions. It should be approved by both the parties. Rights and obligations should be stated. Payment terms should be stated. Then what? Tell me what else? What else? The transaction should have commercial substance, and the amount consideration is probable to be collected. Okay, now how to identify performance obligation? The performance obligation should be a distinct promise to transfer goods or services is performance obligation. Now distinct, it should be distinct on its own and not or, and it should be distinct in relation to other promises in the contract. Okay, now when I say distinct on its own means, it means entity sells separately and customer can purchase. Whether they purchase or not doesn't matter. Customer can purchase separately now What is the meaning of distinct in relation to other promises in the contract? No significant customization, modification, and or no significant customization, modification, or interrelation. Let me highlight this. Done. Transaction price. What is the meaning of transaction price? Can you please tell me? Transaction price is a price, that is the transaction price is the amount entity expects to receive for transferred goods or services, excluding amounts payable to third parties. Okay, now here there are multiple cases which we need to understand. One is variable consideration, another is significant, financing component, then is a non-cash consideration, then is consideration payable to customer. Okay, shall I write about these also here itself? I think it will be better for you to revise. It will be better for you to revise. Now, if it is a variable consideration, point is, will we include this in transaction price? Do we include this in transaction price? Now the standard says that yes, we include in transaction price if it is highly probable. If you have to use this line, if a question comes for if a question on variable consideration comes in the exam, you have to use this line. If it is highly probable that a significant reversal of cumulative revenue recognized will not occur when uncertainties are resolved. You have to use this line as it is. You have to use this line in the exam. Okay, we have to include. But comes the next question. At what amount? At what amount? At what amount? Now, estimate the amount using either most likely method or expected value method. Okay, now what is the meaning of most likely method? What is the meaning of most likely method? A single amount whose probability is more than 50%. What is the meaning of expected value? Multiple scenarios with none having probability more than 50%. Now under expected value method, transaction price will be equals to the most likely amount multiplied by probability percentage. We will not multiply with probability percentage. Strike through. Students, do make a mistake. I am highlighting it off here. I'm highlighting it off here. Don't make this mistake in the exam. Okay. Now, transaction price is equals to amount multiply with probability. Percentage. Is the variable consistent clear to all of you? Come on guys, tell me. Is variable consistent clear to all of you? Yes, you can write here. That also you can write. Sum of probability weighted average. Chalo, ठीक है. That also you can write here. Significant financing component. What is the meaning of significant financing component? A gap between transfer of goods or services and consideration. When there is a gap, now there can be two situations here. Case A, consideration. Okay, now transfer of goods services today, but consideration after. Okay, then in this case, recognize revenue at cash equivalent price. If it is not available, then present value of contractual consideration. If it is not available, then present value of contractual consideration. Okay, then this is case A. Now under case B, case B is consideration received today and but transfer of goods or services after. Later word is good. Yes, later word is good. Later. Okay, here, so in this case again, recognize revenue at cash equivalent price, or if not, then future value of contractual consideration. Any amount received today is contract liability. Is a contract liability. I believe it is clear to all of you. Significant financing component. Now moving on to the next topic, that is non-cash consideration. So non-cash consideration, recognize revenue at fair value of non-cash consideration. At fair value of non-cash consideration. Tell me, is it clear? What's the difference between contract asset and contract liability? I'll discuss with you, Azim. Don't worry. I'll discuss with you. Don't worry. First of all, let me complete this point. Let me complete all the 5 steps and then I'll discuss your point, Azim. Okay, don't worry. But just keep in mind, just don't forget your query. Okay, I'll discuss for sure. Now, non-cash consideration, discuss consideration payable to customer. Okay, if there is any consideration that is payable to the customer, okay, for any consideration payable to customer, okay, reduce transaction price, okay, if there are no receipt of any goods or services from customer. Okay, means I have paid an amount to the customer for which customer has not given me anything, so it is a reduction of the transaction price. Done. Allocate the transaction price to each performance obligation. Tell me, in the ratio of stand-alone selling price. But comes the question, what if now the question that comes up, what if SSP standalone selling price is not available? Then in that case we take adjusted market price. If that is also not available, then we take cost plus margin. If that is also not available, then we take residual approach. Okay. Now, if any discount is given, then allocate the discount to all performance obligations, again in the ratio of standalone selling prices. Now, recognize revenue as and when the performance obligation is satisfied. Okay. Now, question will not specifically mention, but question will give you hint. Okay. Question will say standalone selling price is not available, but the competitor sells the similar product at this price. Okay. So, question will give you hint. Now, tell me, when is performance obligation satisfied? Performance obligation is satisfied when control is transferred. Okay. Now, understand, control can be transferred at a specific point in time or over a period of time or over time. Meaning thereby, can you give an example? Yes. Let's suppose I am selling you this mobile phone. I will sell, I will receive money. Control is transferred at a specific point of time. But let's suppose you purchase my SBR classes. So the control will be transferred over a period of 2 months. Okay. That is called overtime. But comes the question, how to determine whether it is point in time or over time? So now the standard has given you the formula for that. Standard says that if any of the below conditions, criterions are satisfied, any, then overtime, else point in time. And what are the three criterions? These three. Now, three criterions are: customer simultaneously receives and consumes the benefit as the entity performs. Like for example, if you are in my SBR class, as and when I'm teaching you, you are receiving the benefit. Condition number one satisfied. If condition number one satisfied, control is transferred over a period of time. Okay, now condition B, entity's performance creates or enhances an asset that the customer controls. Student is saying B and C are confusing. Don't no need to be confused. I will explain. Don't worry. Think of an example. I'll give two examples. Just understand. Just try to understand using those two examples. Okay, just try to understand. Point number one, guys. Please, this is an important point. You guys have asked me, and I'm explaining it also. Bani, please understand. Let's suppose I have my own land. Okay, I hired a contractor. So here the contractor is the entity. I am a customer. Okay, I hired a contractor and asked contractor to develop a studio on this land. Okay, and I will be giving him the money. Now tell me, as and when the contractor develops the asset, tell me, contractor is the entity. Entity's performance creates and enhances an asset. The studio is being built. Tell me, who controls the studio? I control the studio. That the customer controls. Condition number B satisfied. Now, in this point itself, continuing further, entity does not have the alternative use of the asset. Tell me, can that contractor use this studio for their own purpose? No, they can't. Now, I didn't like the work of the customer, and I told the contractor, I didn't like the work of contractor, and I told the contractor, please go away. I didn't like your work. So tell me, will contractor go off like this, or he will say, see, I have done 30% of the work. Give me the payment for 30%. Right? So entity has the enforceable right for the payment, right to payment for the work done till date. This is condition number C. I am highlighting these in red so that you, when you revise over the next 3 to 4 days, you understand, okay, what are the keywords. Okay, now, please understand. See, if the control is getting transferred at a specific point of time, there's no challenge. I transferred the control, I received the money, I will recognize revenue. But if the control is transferred over a point of time, let's suppose over 3 years, contract price is, let's suppose, $1 million. Tell me, how will I recognize revenue? In the current year, how much work is done? So for that, if control is transferred over a period of time, Then how to measure progress using input method, that is costs incurred till date divided by total estimated costs, or output method is work certified till date divided by total contract price. How to measure progress? Clear everyone? Clear everyone? Okay. Now, I believe now you can recognize revenue. Now I have to talk about one important point: loss making contracts. No one talks about it, but the examiner has asked the questions in the past and can ask in the future also. You never know, this question can come up in the exam also. Loss making contract. Tell me, for loss making contract, how do you recognize revenue? Please understand. Let's suppose I have drafted an example for loss making contract. Let me discuss that with you guys. It's 8 p.m. now, and it's been 6 hours 11 minutes since we are studying. I think that's a record that we are making, right? Yes, you are identifying it correct. Now, please understand. Contract price is 1000. Cost incurred in year 1 is 900. Total estimated cost of the year 2 is 300. Evaluate the contract. So tell me, what is the measure of progress? What is the measure of progress? It is 900 in cost incurred till date divided by 900 plus 300, that is equals to 75% work is done. 75% work is done. So tell me, what is the revenue that we should recognize? Just hold on a minute. Let me draw a table. Revenue. What is the amount of revenue? Revenue should be 1000 multiplied by 75% is 750. Now, what is the costs? It is 900. Hence, comes up a loss of 150. It's a loss making contract. So whenever there is a loss making contract, you have to do first of all, what you have to do is identify total loss. What is the total loss? 1000 minus 900 plus 300 is 1200 minus 1000 is 200. Loss recognized in P&L is 150. Loss yet to be recognized, loss not yet recognized in P&L, 50. This is your onerous contract. Onerous contract. Okay. So for this, make a provision. Make a provision for onerous contract. Journal entry will be debit cost of sales, credit provision for onerous contract. Okay. So here you have to recognize plus 50, and the loss in P&L will be 200. Clear everyone? Done. Huh. Now we have to discuss about special models, special business models. So understand principal versus agent. So tell me, principal recognizes revenue on gross basis. No, in this case it doesn't come up. Okay. Now, or agent recognizes revenue on net basis. Now one student asked me something. I will first of all I'd like to take the opportunity to discuss that part which a student asked. Just a minute. Just give me a minute. Contract asset, contract liability. Now just hold on a minute. Let me discuss that also. Revenue. See, these are the notes which I'm making. I just thought to show you. These are the notes which I'm making for my new SBR batch, new SBR capsule. Okay, this is how it will look like for the new batch. Everything in detail. Everything in detail. Examples and everything are already included in the book itself. See, when you talk about contract asset, contract liability, see it is already here. Contract asset, contract liability. I'll copy it from here. Now see here. Thank you guys. Contract asset. For contract asset, from a revenue point of view, it is cumulative revenue recognized till date, and out of which, what is the amount already invoiced? The less part, the remaining part is contract asset. From a cost point of view, if you have paid something extra, that is your contract asset. Cumulative costs paid minus cost recognized in P&L is your contract asset. For a contract liability, please understand, sorry, for a contract liability, if the amounts received are higher than revenue recognized, means deferred revenue is your contract liability. From a cost point of view, if some costs are outstanding to be paid, it is a contract liability. Cumulative cost recognized in P&L, expense in P&L less costs paid. Let's suppose we have recognized an expense of 100, but we have paid only 80. So 20 is your contract liability for that case. Chalo, special cases. Now, principal recognizes revenue on a gross basis. Agent recognizes revenue on net basis. Comes the question, how to identify principal versus agent. A party, okay, there are three indicators given. Okay, you have to identify on a case to case basis. Who bears the inventory risk? Who has the right to establish price? Who has the primary responsibility of fulfilling the contract? who has the primary responsibility of fulfilling the contract. Okay, now please understand, let's suppose there are three parties: make my trip, Indigo, make my trip, and customer. Okay, if the control of the flight tickets passes directly from Indigo to customer, if the control of the flight tickets passes directly from Indigo to customer, then make my trip is just an agent. Then make my trip is just an agent. But if the control first of all transfers to make my trip, and from make my trip control transfers to agent customers, then make my trip is a principal. Can you give an example? Yes, let's suppose make my trip purchases 50 tickets from Indigo. Okay, 50 tickets from Indigo. If make my trip is able to sell 50 tickets, fine. If make my trip is not able to sell 50 tickets, it's a loss of make my trip. Then in this case, make my trip is a principal. Sale with a right to return. Tell me, on the date of sale, oh, on the date of sale, what will happen? Recognize, first of all, identify the expected returns percentage then now accounting will be just a debit bank credit revenue, let's suppose say 5%, okay, we expect the returns to be 5%. Okay, so in the bank we will record 100, in the bank we will record 100, in revenue we will record 95%, and credit refund liability, because we, if it comes as a return, we might have to refund 5. Now similarly for the cost also, costs, so for that, cost of sales for 95 debit, then debit right to return asset 5, and credit inventory 100. Okay, now on the expiry date of returns, what will happen? On the expiry date of returns, what will happen now? So for that, let me draw a table. If goods are returned, if goods are not returned, so if goods are returned, then we will write debit refund liability, credit bank, and debit inventory, credit right to return asset. But if goods are not returned, then what will happen? Debit refund liability, credit revenue. Not returned means it's my revenue now. Okay, now debit cost of sales. Okay, so let me highlight the important terms here. Credit bank, done. So this is sale with a right to return. Now what's next? breakage, and students have asked me lot of times, sir, breakage. Chalo, let's discuss breakage. What is breakage? It is nothing but based on the concept of variable consideration. What happened? It is nothing but based on a concept of variable consideration. Okay, let me explain this with the help of an example. Kiki company sells $50 goods. Okay, gift cards. So now tell me, on the date of sale, of gift card, you can think of gift card as Amazon vouchers. Date of sale of gift cards. Tell me, when the gift cards are sold, company received the money, debit bank, credit what? Tell me, did Amazon transfer any goods or service on that date? Tell me, do you think Amazon transferred any goods or service on that date? No. No. So credit contract liability. By what amount? 50. 50. Now, subsequently, tell me, do you think all the person to whom you give Amazon gift voucher, they all of them use it? Do you think all of them will use it the entire amount? No. No. So entity believes that customer will redeem 70% of the value of the gift card. Entity believes customer will redeem 70% of the gift card, right? So meaning thereby, what is the variable consideration? What is your consideration? Variable consideration. Understand? Please understand. Okay, so understand, 70% of the value of the gift card and the remaining 30% will expire unused. Unexercised rights of the customer are called as breakage. Unexercised rights of the customer, that is 30%, is called as breakage. Okay, so in that case, subsequently, what will happen here is we will apply our best estimate and recognize revenue. So in standard says that for each dollar redeemed, Kiki company should recognize revenue of 100 by 70, which is equals to how much? 100 by 70. 1.43. Now what happens? We estimate, just analysis, our analysis. Entity estimates 70%. Entity estimates 70. Can you please confirm the chat box, guys? Am I audible? Can you please confirm, guys? I think there is some network issue. Can anyone please send a message in the chat box? Chalo, I'll continue further here from here. Now, the next topic that is there is crowdfunding. I'm just worried if the network is there or not. Is there any network challenges again? Thank God. I think it has connected again. It has connected again. I was not able to see your messages. I am so sorry for the issue. Okay, chalo. Let's continue. Now we will. I believe this breakage concept is clear to all of you. I believe this breakage concept is clear to all of you. Analysis part was missed. Okay, for no worries. I'll explain. Okay, an entity estimates that 70% will be utilized by the customer. Okay, so 70% is, see, what is the value of the gift card? 50. 70% is 35. So for each dollar, if I am recognizing a revenue of 1.43, so for $35, how much revenue will I recognize? 50, and that's the contract liability which I have recognized. So for each dollar that is used by the customer, I will recognize revenue like this: debit, contract liability, debit contract liability by 1.43, and credit revenue 1.43 for each dollar. For each dollar UT redeemed by the customer. Clear? What if the entity cannot determine unexercised rights? Do you think entity will not be able to? Amazon issues gift cards day in day out. Don't you think on the basis of past history they will not be able to estimate that how much percentage will be unutilized? They have all the analytics. They can very well identify that. Okay, now comes the next topic is crowdfunding. Crowdfunding means an entity accepting the money from the general public. Now comes the question: why are we accepting money? Why are we expecting money? If we are accepting the money in lieu of issue of equity shares, It is equity based crowdfunding, and the journal entry will be bank account debit to equity capital. Okay, if we are accepting the money in lieu of a loan, then the journal entry will be bank account debit to financial liability. If we are receiving the money from the general public in return for some goods or services, it is called as reward based. Do you remember we would have solved one question? We would have solved one question of Mr. Mavic, where the drones was to be delivered to the customer. Do you remember that? Drones was to be delivered to the customer. They have done the crowdfunding, received the money, and in receipt of the money, we have to issue crowd drones, the Zolo drones to the customers, right? So for that, what I have told, if you have received the money in lieu of issue of Zolo drones, that is to be recognized as revenue when you transfer the drones to the customer. As of now, when you receive the funds, it will be bank account debit to contract liability. When you receive the funds, it will be bank account debit to contract liability. When you deliver the drones to the customer, it will be contract liability account debit to revenue. Now, contract costs. Contract costs are of two types. One is contract acquisition costs. Another is contract fulfillment costs. So if they are incremental in nature, incremental cost means cost it will be incurred only if the contract is entered into. Only if the contract is entered into, then recognize as contract asset and amortize over contract term. Else, expense of to P and L operating category. Okay, now contract fulfillment costs, we have to see if it is covered under some different standard, might be IS2, covered under different standard. If it is covered in different standard, then we will apply that standard. Okay, else you have to recognize this as a contract asset and amortize over the contract term. Okay, so this completes our chapter of revenue. And now we are moving on to the next chapter. That is fair value measurement. Do you need a break of 10 minutes now? We will need 1 more hour to complete. Now students might be wondering, sir, what about group accounting? So for group accounting, in the last attempt itself, I have taken a detailed marathon. Okay, for group accounting of around 5 hour 45 minutes marathon I have taken for group accounting already, where I have discussed all the examples. So for group accounting, that class will be applicable. I'll show it to you. What I have discussed there. Just a minute. See here, in that group accounting lecture, we have already discussed the step acquisition, contingent concern, loss of control, purchase or loss without control, notional goodwill, replacement award, reacquired rights, tax. In the important points, joint arrangement, associates or joint venture, foreign subsidiary, everything is discussed. Everything is already discussed as part of that video. So I will give the link of that video in the description box. Okay, and not only concepts I have discussed along with examples. There are roughly around, I believe, 30 to 45 examples which I have taken up in the class. So I believe that is the most detailed marathon for group accounting which you can watch. No further marathon needed for that, but rest I will be discussing it now. So I will need further 1 more hour for that. So let us take a break of 10 minutes and then we'll wrap it up within next 1 hour. Okay, because all the big chapters are already done, we are left with few small chapters, and but these small chapters are also important because employee benefits very important from an exam perspective, and I'll be discussing see few examples which will help you strengthen the concepts. So I'll need around 1 to 1.5 hours more. So for that, let us take a break of 15 minutes now, and then we will resume back. Come on, guys. Shall we resume back? Come on, guys. Tell me. क्या बोलती public? Shall we start, guys? Quickly, quickly. Now, we have done almost everything. Yeah, what is remaining is just small topics. Let's go. Okay, chalo. What is the meaning of fair value? Fair value. So, fair value. So, first of all, understand fair value is exit price. It is exit price. Okay. Now, fair value. What is the meaning? Fair value is the price. Is the price. Price received to sell an asset or settle a liability in an orderly market between market participants at measurement date. Basically, if I have an asset and I want the fair value. So at what price can I sell it? At what price can I sell it? At what price can I sell it is the fair value. Okay. If I have a liability, at what price I can settle it is my liability. Okay. The exit price of an asset or an exit price of a liability is the fair value. Please understand, fair value is the market price minus the transportation costs. Okay. Now, how to evaluate fair values? First of all, step number 1 is identify the asset or liability. Step number 2 is identify highest and best use. Now, on this single word, there can be a full question. On this single word, there can be a full question. Highest and best use. Now, what is the meaning of highest and best use? Let's suppose this area, this area is a studio. It's an studio, okay? And the value of this studio, is, let's suppose, $1 million. But if this studio is converted to a residential property, the value which I can get is $1.5 million. So in that case, I'll say the highest and best use is the residential use. Even if I'm using it for commercial purpose, doesn't matter. Even if I am using it for commercial purpose, doesn't matter. If I am getting the highest value in residential property, that's the highest and best use, provided it should not be legally restricted to use it for residential purposes. Okay. Current use is presumed to be the highest and best use, but highest and best use can be different if question provides you with data. Okay, done. Now, markets. There are two types of markets. One is a principal market. And one is most advantageous market. Principal market is a market where the asset is sold with highest volume and frequency. It is traded with highest volume and frequency, is called as principal market. Most advantageous market is computed if principal market cannot be determined, then most advantageous market is the market with highest benefit. Okay, now the disclosure. So disclosure, as you guys know, it is disclosure of level 1 inputs, level 2 inputs, level 3 inputs. Now, what is the meaning of level 1 input? I have invested in the equity share of Google. So there is a quoted price unadjusted in the active market for identical assets and liabilities available. Okay. Now, if the quoted price in the active market is not available for the identical, see, understand, you need to understand the difference between identical and similar. These two are similar, not identical. How to find identical now? Yes, these two, see, these two are same keys. These two are the same keys. They are identical, exact same in all respects. Exact same in all respects. They are identical. Okay. Now, so if the quoted price is available for the identical goods and identical, then it is level 1. If it is available for similar, then it is level 2. But if the quoted price is not available, you have unobservable inputs, then it is level 3. Okay, done. Moving on to next chapter, that is agriculture and inventories. Now, agriculture and inventories. Please understand. Measurement of biological assets. Initially, it is measured at fair value less cost to sell. Subsequently, also it is measured at fair value less cost to sell. Any gain or loss is recognized in P&L. Done. Okay. Agricultural produce, at the point of harvest, it is recognized at fair value less cost to sell. Okay. Subsequently, so at the point of harvest, it is recognized at fair value less cost to sell. Subsequently, it is classified as inventories. As inventories, fair value less cost to sell at point of harvest becomes cost and now valued at lower of cost or NRV. Inventories. What is the meaning of inventories? Goods held for sale in the ordinary course of activities. Okay, then it can be raw material, stock in trade, work in progress, finished goods. Now, it also includes primary packaging material. There was a question in the past attempt on this one. Primary packaging material, not of significant mark, but there was a question. But it includes primary packaging material, but it does not include secondary packaging material. Now, what is primary and what is secondary? So standard says that any packaging material which is essential for the goods to be transported is primary, but secondary is anything which is required, just for the advertisement purposes is secondary. For example, this mobile phone, the case of this mobile phone, right? The case of this mobile phone, okay, it was required to cover the essential integrate compose or what say elements of this mobile phone, okay. So this primary packaging material, it is a part of the inventory. But let's suppose the packaging box, the packaging box, it was for advertisement, that is not a package, that is not a inventory. Okay, it also includes spare parts, loose tools, held as consumables, okay. Yes, buddy. The tube of toothpaste is a primary packaging material, but that carton over the toothpaste, okay, that square box, okay, that is not a that is secondary packaging material. Okay. Now, cost of inventory includes cost of purchase, conversion costs, and other costs. Other cost is the cost incurred to bring the inventories to their location and condition. Okay. Now, valuation of inventories happens at lower of cost or NRV. Now, for stock in trade, and finished goods. Okay. For work in progress, what about work in progress? For work in progress also same thing, but here the work in NRV is equals to estimated selling price minus costs to complete minus costs to sell. Okay. Now, for raw materials, if the finished goods is sold at or above cost, then raw material is at cost. If the finished goods is sold below cost, then the raw material is measured at its replacement cost. Okay, chalo. Share based payments. Moving on to the next standard, that is share based payments. Okay, now what is the meaning of share based payments? Entity purchases, obtains goods or services or assets. Is it for free? No. In exchange for either shares of own entity or cash based on market price of shares of own entity. Now, accounting treatment. If it is an equity settled share based payment plan, we will take fair value on grant date. If it is cash settled, we'll take fair value at each reporting date. Do we remeasure here? No remeasurement. Remeasurement happens here even after even after vesting period. Option expense, how do you recognize? So it is employee benefit expense, debit employee benefit expense, credit share based payment reserve. Here it is debit employee benefit expense, credit provision for share appreciation rights. In exercise period, no remeasurement, I have already written here. Settlement date, okay, if exercised, then the journal entry will be SBP reserve, debit, credit equity capital, credit share premium, okay. Now if lapsed, then SBP reserve, debit, credit retained earnings. Now in cash settled share based payment, please understand, settlement happens at intrinsic value. Settlement happens here at intrinsic value, okay. Now what is the meaning of intrinsic value? Market price minus exercise price, okay. Now so here the journal entry will be provision for SAR, debit, which was made at fair value, but credit will be bank, but this will happen, credit will happen at intrinsic value, and here any difference goes to P&L is employee benefit expense. Any difference to P&L as employee benefit expense. Okay, now what's next? The share based payment with settlement alternative, an important topic. Let me explain this with the help of an example. Okay, so now on grant date, subsequently so what will happen on grant date? So you will have to first of all find out what is the value of equity option. What is the value of equity option? Tell me guys. The value of equity option will be, let's see, on 1st July 2001, the company grants an employee a right that allows them to choose either 20,000 shares or cash to the value of 18,000 shares. Okay, now so value of equity is 20,000. What is the value of equity option? The fair value of share root is 4.9. 4.9. What is the value of cash option? $18,000 multiplied by 5. So what is the values? 20,000 into 0.9 is 98,000, and here it is 90,000. So now understand. So what will be the value of equity? What is the fair value of equity alternative? What will be the fair value of equity alternative? Can you please tell me, guys? Now it will be 8,000. It will be 8,000. It will be 8,000. So please understand here. Please understand. Since the value of equity is more than the cash, so the excess part is allocated to equity. But let's suppose rather than 98,000, if this would have been 88,000, rather than 98, if this would have been 88, then in that case, value of equity would have become zero. Okay. Now what will happen is, so please understand subsequently what will happen. How many years? X1, 2, 3, 4, 3 years. Equity option, cash option. Chalo. Year and 1, year and 2, year and 3. So for equity is very simple. 8,000 divided by 3 is equals to 2667, 2667, 2667. So this is an expense. Okay, and reserve, SBP reserve will be 2667. Uh, 2667 into 2 is 5334. 5334. 8,000. Now for cash option, what is the expense? Chalo, tell me, guys. 18,000 shares multiplied by, what is the fair value at the reporting date? 5.35 into 1 by 3 liability is how much? Can you please compute the value and tell me, guys? 18,000 into 5.35 by 3 is 32,100. Then here again, expense will be how much? 5.8. 5.80 into 2 by 3. But here you have to minus the expense for the first year. Minus 32,100. 18,000 into 5.8 into 2 by 3 minus 32,100 is 37,500. Liability will be 69,600. Here for the third year, 6.1. Come on, guys, tell me, are you enjoying this? I am enjoying it a lot, guys. Come on, tell me. We are studying at a stretch for last 7 hours 25 minutes. So it is 18,000 into 6.1 minus 32,100 minus 37,500. 40,200. 40,200. So it is equals to 69,600 plus 40,200 is 109800. Done. Done. What say, guys? Clear? Clear है क्या, guys? बोला ना guys. I believe it is clear, everyone. चलो. Ta-da, ta, ta-da, ta, ta-da. Now, moving on to the what type of energy drink do you take? Chalo. Moving on to the next chapter, that is operating segments. Here the most important examinable area is the how to identify the reportable segments. Okay, I believe you know the meaning of segments, operating segments. So operating segments are a division of the company which generates revenue, incurs cost, okay, incurs cost and has a discrete financial information available for it, and a CODM, chief operating decision maker, reviews the financial information, कैसी बहकी बहकी बातें करते हो तुम प्रद्युमन? ये स्टूडेंट समाज तुम्हें माफ नहीं करेगा. मेरे घर वाले भी आते हैं कभी कभी ऐसे मेरे ये सीरीज को देखने के लिए. सोचो अगर वो ये मैसेज पढ़ेंगे तो क्या बोलेंगे. चलो, let us start the new chapter of operating segments. Okay, so how to identify a reportable segment? Okay, so limit number one, if the segment revenue is 10% or more of the total revenue, okay, if the segment set is 10% or more, okay, if any of these, see there is an or, if any of these is satisfied, it is a reportable segment. If any of these satisfied, it is a reportable segment. Okay, now the CODM has a right to voluntarily make a segment as reportable even if the threshold is not met. Even if the thresholds are not met, then also voluntarily a segment can be made reportable. Okay, let's suppose a company is working on something crucial, a company is working on a project which is very crucial, okay, for the growth of the nation, okay, and they want to disclose it to the Indians, okay, the nationals. So they can disclose that as a segment. Then, if the segment was reportable in the previous year, it will be reported as a segment in the current year also. Voice issue can't be the case. Hello. Hey guys, no, voice issue can't be the case, yaar. Voice is working perfectly fine. हाँ, वही तो. Now, after you have identified the reportable segments as per limit 1, limit 2 and limit 3, after you have identified the reportable segments as per limit 1, limit 2 and limit 3, then just compare the external revenue of the reportable segment as per limit 1, limit 2, limit 3 should be more than 75%. So meaning thereby the reportable segments should have at least 75% of the total revenue. The reportable segments should have at least 75% of the total revenue. If that is not the case, then you have to make some additional segments as reportable to meet this 75% criteria. Okay, now once you've identified the reportable segments, report them, and rest all other segments will be classified as all others. Now, moving on to the chapter of provisions. I think now we are good to go. Provisions we are done. Provisions events won't take much of time. Employee benefits. See, employee benefits is a major chapter which I have to take. Employee benefits and income taxes. After that, nothing is left. Yes, that's all. That's all. How many chapters? 1, 2, 3, 4. Only 4 chapters remaining, and I'll take around, roughly you can say around, I can take 45 minutes more. 45 minutes more. Okay, now a student is asking about shareholders or investor perspective. Guys, whenever a question comes from an investor perspective, just think how this information is useful. Think like an investor. Think like an investor and tell why this information is useful in the decision making of the investors. Okay, now provisions. Okay, now this one chart can help you identify. Okay, whether it is a provision or a liability or a contingent liability. Please understand, if it is a present obligation, forget about it. Understand, I am saying something, listen to me. If it is a present obligation, what is the meaning of present obligation? Means even if you shut down the company today, you have to pay this. You have to pay this. You cannot avoid. It is called as a present obligation. Okay, if you have a present obligation and the amount of liability, amount of payment and timing of payment is certain, it is a present obligation and amount and timing is certain, then liability. Next point. Okay, shall I start writing these points? Chalo. If it is a present obligation plus amount and timing is certain, then it is a liability. Now understand, if it is a present obligation and amount in timing is uncertain but can be estimated, then it is a provision. Again, if it is a present obligation and amount in timing is uncertain and but cannot be estimated, then it is a contingent liability. Then it is a contingent liability. Is that clear, everyone? Okay. If it is a possible obligation, it is a contingent liability. If it is a remote obligation, nothing, no treatment. Okay, now next point. If it is if any receivable is virtually certain. What is the meaning of virtually certain? Probability of receiving is more than 95%. Okay, then it is an asset. Rest all cases, okay, contingent asset or nothing, no treatment. Okay, now understand the treatment of contingent asset and contingent liabilities. If material doesn't mean only amount wise, quality wise also. Okay, information is material. Okay, even though amount wise not material, then also it has to be disclosed. It has to be disclosed in notes to accounts. Similar thing here also. Okay, if further it becomes virtually certain, then recognize it as asset and income. Yes, Palak. Query. Please tell me your query. What is the query of Palak? Palak, tell me your query. Did I miss something on your query? No, I don't think so. Can you please resend your query, Palak? Palak have doubt. Okay, chalo. Events. What are adjusting events? For which conditions, guys, if you are leaving now, you are missing out on some big thing. Okay, I have made some notes for you guys which I want to share with you. Okay, which I want to share with you, and I'll show it and share it with you, and you will actually appreciate those notes. You will actually appreciate those notes. So stay here just 45 minutes more, not 45 minutes also, just give me 30 minutes more and we'll be done with it. Okay, and please understand, it will be of great help. Conditions existing on reporting date. Okay, the events confirm those conditions. For example, a case was already ongoing in the court of law. Okay, on the reporting date, the case was pending. After the reporting date, the court gave the solution of it. The court settled the case. The settlement of the case after the reporting date is a adjusting event. Non-adjusting event means conditions, no conditions exist on reporting date. Okay, now inventory, few specific adjustments. Okay, inventory, if after reporting date fire happened, earthquake came up, okay, and the inventory is destroyed, it is a non-adjusting event. But if NRV of inventory falls, this is an adjusting event. Trade receivables, debtor becomes insolvent, this is an adjusting event. Cases I already told. Okay, now going concern. If any event is non-adjusting, but it impacts going concern, then it becomes adjusting event. Okay, and if it becomes adjusting event, financial statements will no more be prepared under going concern, and the fact has to be disclosed in notes to accounts. Done. Employee benefits. Just keep on telling me the treatment. Come on, guys. Current service cost, where will it go? P and L. Past service cost, P and L. Operating category. Interest costs, P and L, but not operating category. It will go under financing category. curtailment and settlement, it will reduce obligation, it will reduce plan asset. Okay, net difference is gain or loss, P and L operating category. Actuarial gain or loss, carrying amount of net obligation versus fair value of net obligation. Okay, it is recognized in other comprehensive income. Ceiling adjustment, if fair value of net asset is less than present value of refunds or reductions, then the difference is ceiling adjustment recognized in other comprehensive income. Let me highlight that other comprehensive income part. Now, how will you account for these things? Come on, guys. Obligation, chalo, keep telling me. Interest will come up here also, here also, here also, right? Current service cost will come up here only. Past service cost will come up here only. Curtailment and settlement, it will reduce both. It will reduce both. Okay, and this difference will go to P and L. Let me add one more column, row, sorry. Insert rows above. Benefits paid will reduce the obligation and plan asset by same amount, and here there will be no amount that will come up here. Okay, now comes the closing balance. Okay, now compare the fair value, and this difference is called as actuarial gain or loss. Okay, now let us take up some examples to understand this concept in a better manner. If the carrying amount of net obligation is 100, fair value of net obligation is 120, so fair value is more, so it's an actuarial loss of 20, which will be recognized in other comprehensive income. Okay, now again, carrying amount of net obligation, it's actuarial loss, okay, is 100, fair value is 90, liability is reducing, liability is reducing, liability is reducing, so it's a actuarial gain, it's an actuarial gain of 10, which will be recognized in other comprehensive income. Now one more, carrying amount of net asset, please understand, ceiling adjustment comes only and only in case of net asset, only and only in case of net asset. So if a carrying amount of net asset is 100, fair value of net asset is 110, so it is an actuarial gain of 10, which will be recognized in other comprehensive income. Now ceiling is 105, so fair value is 110, ceiling is 105, so it's a 5 again OCI. So please understand, for actuarial you can get actuarial gain or loss, both. It can be actuarial gain, it can be actuarial loss, but for ceiling adjustment there will be a loss only. There will be loss only. It's like impairment, it's like impairment. Clear, everyone? Chalo, income taxes. How do you compute? How do you compute? Done. Last income tax is done. Income taxes and we are done almost. IFRS 18 will not take much of the time. चलो, deferred tax. First of all, compute carrying amount, then compute tax base, then compute temporary difference, then compute, then classify temporary difference as taxable or deductible. Classify. Navdeep is asking something. Kya? Are you doing one for FR? Navdeep, for FR I have done in the last attempt itself, so you can very well refer to that. Okay, so I am making a plan wherein I will take FR and SBR alternatively. It becomes something unrealistic for me to take FR and SBR in every batch for this long marathon. Okay, so what I have planned is one attempt FR, one attempt SBR. So since I am taking SBR in this attempt, I will be taking FR in the next attempt. Now classify temporary difference as taxable or deductible. Okay, now for each taxable temporary difference, recognize deferred tax liability, and for each deductible temporary difference, recognize deferred tax asset. Okay, provided future taxable profits exists. If not, disclose DTD as unrecognized deductible temporary difference. Okay, chalo. Now presentation, please understand. If for items of P&L, deferred tax impact will go to P&L. For items of OCI, deferred tax impact will go to OCI. For items of equity, deferred tax impact will go to equity. Okay, chalo. Now comes the next, revaluation of PP and intangibles. Tell me, where does revaluation gain go? Can you please confirm, guys? Where does revaluation gain go? OCI. So deferred tax impact will be recognized in OCI. Okay, now leases. First of all, deferred tax impact will be recognized in P&L. Now, how will you compute this? Carrying amount will be equals to carrying amount of ROU minus lease liability. Tax base is equals to nil. Then compute temporary difference and compute DTA or DTL accordingly. Okay, done. Now, major importantly, I wanted to take up share based payments, which is a very important point here for income taxes. Now we are done. Just 10 to 15 minutes more. Just give me 10 to 15 minutes more and we'll be done. Okay, now I am speaking continuously from last 8 hours. I am not feeling exhausted. Why are you feeling exhausted? It is a crime that you are feeling exhausted. Come on, guys, everyone with me. How's the Joes, everyone? Come on, guys, tell me, please. How's the Joes? Come on, guys. Now you have to tell me how's the Joes, then only I will proceed further. सौरभ भाई मुझे ऐसे बोलोगे तो मैं रात भर सेशन ले लूंगा. आई विल नॉट हैव एनी चैलेंज. लो हो गया, ऐसे थोड़ी चलेगा. बानी बोल रही है लो हो गया है, प्रद्युमन बोल रहा है लो हो गया है. दिस मैराथन हैव पार्ट टुमारो, नो पार्ट टुमारो, टुडे ओनली विल कंप्लीट एवरीथिंग. चलो, शेयर बेस्ड पेमेंट्स. You guys should keep on motivating me, and you are saying low, sir. Very bad, very bad. Chalo, let's read the question. I will give you the link of group accounting. Pradyuman, don't worry, okay? See, if you want to, so I'll show it here also. Just hold on a minute. Please see. I'll show where exactly you will get group accounting, and then we'll discuss this chapter, this question of share-based payments. YouTube, Vishal Jain, YouTube, your channel. Can you guys see my YouTube channel? Can you guys see my YouTube channel? Okay, now what you have to do is, though I will give you the link in the description box also, but still let me show it to you. Go to the live section. See, like how the session is going live now. Okay, now scroll down, see SBR group accounting. Just see for how many hours? 4 hours 38 minutes. 4 hours 38 minutes. And when I have taken just 3 months ago. Just 3 months ago, I have taken this marathon for group accounting in depth. And I can guarantee you, if you watch this, that 30 marks will be pakka for sure taken up. Okay. But I will request you to watch this video along with this video, one more video. I will give you the link in the description box. Don't worry. This group accounting, one more group accounting. Okay, this is 1 hour 35 minutes. Again, this is also 3 months ago. So for group accounting, I have taken detailed revision 3 months ago in the previous batch. Okay, so you can watch that, and it will be, group accounting will be in the control. Now chalo, let us discuss this question. Chalo. On 1st January 2008, Robin Pandey granted 10,000 share options to an employee vesting 2 years later. Okay, vesting date is 2 years. Fair value of each option at the grant date is $4. So tell me, what is the expense at the end of first year? 10,000 into 4 into 1 by 2 into 1 by 2 is 20,000. Similarly, here also it will be 20,000. Okay, can you tell me what is the cumulative expense? What is the cumulative expense recognized? Cumulative expense recognized in P and L. It is 20,000 and it is 40,000. Okay, now what is the future deductions? Just see, did future deductions we get on the basis of intrinsic value? Future deductions we get on the basis of intrinsic value. Okay, the intrinsic value of share options are $2.2 and 4.4. So it will be 10,000 into 2.2 divided by 1 by 2 is equals to 11,000. Now here it will be 10,000 into 4.4 Okay, it is equals to 44,000. This is future deductions. Okay, now standard says that, tell me what is the DTA here? What is the DTA here? It is 11,000, tax rate is 30%, it is 3,300, and here it will be 44,000 multiplied by 30% is 13,200. Now, okay, so here the entry will be, here the journal entry will be DTA debit DTA by 3,300, credit P and L 3,300. Okay, now here you will do what? DTA debit by what? Debit will be what? 13,200 minus 3,300. You will create DTA of 9,900. But now the challenge, now the actual question comes up. Will you write credit P and L entire amount of 9,900? No, that will be wrong. That will be wrong. Why? Standard says that for the items of P and L, deferred tax has to be recognized in P and L. What is the expense that you have recognized in P and L? 40,000. So deferred tax impact up to 40,000 has to go to P and L. But over and above, that is 4,000. Over and above, that is 4,000. Okay. The base transaction is equity, share based payment, equity, right? So it has to go to equity. So credit equity, deferred tax impact of 4,000, that is 4,000 multiplied by 30%, that is 1,200. Okay, now the rest will come here, P and L. The rest will come here, P and L. How much? 9,900 minus 1,200 is 8,700. 8,700. Nah, not 4,000 to equity. 4,000 ka tax impact will go to equity. 4,000 ka tax impact will go to equity. So the standard says, now I'll tell you what the standard actually says. I'll take it to next page. Insert page break. Standard says that, okay, if the cumulative, if the future deductions exceed cumulative expense recognized in P and L, if future deductions exceed the cumulative expense recognized in P and L, then the deferred tax impact of excess will be recognized in equity. Is that clear, everyone? Is that clear, everyone? Cool. Now give me a minute. Let me discuss the IFRS 18 part. Okay. Now IFRS 18. Please see, guys, IFRS 18. So IFRS 18, previously there are three changes in IFRS 18. There are three changes in IFRS 18. Okay. First from a P&L perspective, previously we used to make P&L like this: revenue minus cost, gross profit minus all the costs and income, PBT, tax, profit, right? Now this is how we prepare the P&L. I have highlighted each and everything. It is self-explanatory. Basically, there are 5 subtotals now. Please see here. One is gross profit, another is operating profit, another is profit before financing and income taxes, then profit before income taxes, then profit from continuing operations, and then profit from discontinued operation. These are the 5 heads. In P and L. Nothing else. See, I have already classified Nothing to mug up, nothing to understand. Just see and you are done. Moving on to second change. I have summarized all the changes here itself in the face. Second change is from a cash flow perspective. Tell me, earlier in cash flow from operating activities, we used to start from profit before tax, right? Now you will start from operating profit. Now you will start from operating profit. I have given you an extract or an illustration of that as well. See, you will start it from now from operating profit. Okay, now previously finance costs, some questions you used to see and students used to ask me, sir, finance cost is an operating activity or investing activity? Okay, some questions operating, some questions financing. Now the standard is saying clearly it is a financing activity. Finance cost is a finance cost cash flow, the interest that you pay actually outflow is a financing activity. The third is MPM. See, for cash flow, I have drafted an example and solved it also. I have already solved it and I believe you should refer to these notes. Okay, now MPM. What are MPM? So MPM is a subtotal of income and expense. It is used in public communications. It communicates management's view of the entity's overall performance, and it is not required by any IFRS standards except IFRS 18. Okay, so please understand. Can I say that free cash flow to the entity is an MPM? No, it is not a subtotal of profit, incomes and expense. Can I say ratios, operating profit margin, gross margin, ROC, are these MPM? No, they are also not MPM. MPM are subtotals of incomes and expense. Basically, if you play in any of these subtotals, if you play around any of these subtotals, it is called as MPM. Let's suppose operating profit plus other operating expense, MPM. Now, profit before financing and income taxes minus profit income tax on borrowings is a MPM. If you are playing around any of these profitability, it is an MPM. Okay, you are arriving at a new subtotal. There are total 5 subtotals: gross profit, operating profit, profit before financing or income taxes, profit from continuing operations and discontinued operations. Okay, if you play anything around this, okay, it is called as MPM. Okay, when I say play means you adjust, like for example, operating profit plus goodwill impairment loss, you say it as adjusted operating profit, it is an MPM. Okay, so whenever you make an MPM, that has to be disclosed in the notes to accounts, and what MPM you have made, how have you calculated it, reconciliation to the nearest subtotal, nearest 5 subtotals. Okay, let's suppose adjusted operating profit, so you have to reconcile it with the operating profit. If you say adjusted gross profit, so you have to reconcile with gross profit. Okay, now they are separate from APM that you study. APM is anything apart from MPM. APM will have ratios, APM will have free cash flow to the entity. APM is anything and everything except MPM. Okay, in the exam, these 4 types of question can be expected from IFRS 18. I have made all the notes. I will be sharing this with you. Don't worry. Groups, as I mentioned, I will be referencing the video. Yes, accounting policies. If there is a change of accounting policies, can debt ratio be APM? Yes, it is an APM. It is accounted for retrospectively. Change of accounting policies is accounting estimates is accounted for prospectively. Prior period errors is accounted for retrospectively. Chalo. Now, related parties, guys, understand it's a self-study topic. What I have done is I have identified all the related parties for you guys. Not only that, I have also identified which are the parties which are not related parties. Okay, give it a selfish read. For conceptual framework, okay, you need examples of accounting policy change. Example, change from FIFO to weighted average cost method of inventory is an example. Accounting estimates change of ECL on trade receivables is an estimates. Or why to go this much? Useful life of PPE, residual value, depreciation methods. Okay, chalo. Now for conceptual framework, okay, question might ask you the deferred tax asset versus conceptual framework, are they in line or are they conflict? So I have made the notes. It is self-study notes. You can read and refer it on your own. Okay, how to draft your answer in the exam if a question comes on conceptual framework. See, whenever a question comes on the conceptual framework, they will test your knowledge on five elements, that is asset, liability, income, expense, capital or equity, right? Or recognition or derecognition. Okay, so define as per the conceptual framework, define as per the relevant IFRS, compare and then conclude are they in conflict or they are aligned with each other. That's all. How to do that? I have done for two data. I have already done that. Okay, now ethical duty. Students generally struggle how to write the answers. So I have done, first of all, identify the ethical issues, link the ethical issue to the fundamental principles, recommend the action. Okay, your actions should be either to eliminate the threats or reducing them to acceptable levels. Okay, this completes our discussion. Additionally, what I have done is I have evaluated past 10 papers and I have tried to bring in the example of each and every fundamental principles. For ethics, this is an example. For objectivity, self-interest threat, this is an example. For advocacy threat, this is an example. For intimidation threat, this is an example. For confidentiality threat, this is an example. For professional competence and due care, this is an example. For professional behavior, this is an example. I have also tried to make a list of recommended actions to be taken. Conflict of interest, preparation of the financial statements, sufficient expertise, okay, financial interest, inducements, non-compliance with the laws, breach of fundamental principles, everything is done in this file. Okay, if you just refer it, it is good to go. Pradyuman, IAS 21 is covered with the group accounting chapter. Okay, I will be sharing these notes in the Telegram group for all of you. So I request all of you, please do join the Telegram group and there you will get all the notes. Okay, so now what is pending from my side? I will give you the link of the 2 videos of the group accounting in the description box of this video. Second, I will give the notes in the Telegram group, which I will try to share, either by end of day today, by late night, because I will have to structure the notes for you guys and then send it to you. Okay. Now, what you have to do is you have to watch this session. Okay, this session will be available. This session will be available on YouTube till the exam day. It will be available. Okay, so watch it unlimited times, whatever you want to, whichever one you want to standard. I will give the timestamps also by tomorrow. But now one request: once this session ends right now, I request all of you to share this session with all the students who are appearing ACCA, wherever you are connected, whichever group you are connected, just share this video, okay? And also share a feedback in the comment section of this video. Share the feedback in the comment section of this video as the session ends, okay? I believe you guys enjoyed the session. It was a wonderful learning. Now sustainability also I have taken up. I will give the link of sustainability also in the description box. Okay, sustainability, I will give the link in the description box. Okay, now where is Forex covered? Forex is covered as part of group accounting, that video. Okay, now in the last 3 days, I request all of you to revise as much as you can. Try to read at least last 3 attempts exam past paper ka suggested answers. Try to read at least 3 attempts suggested answer, 3 attempts examiner reports, all the technical articles. The more you read now, the better you become. Okay, that's all for today, guys. I wish you all the best for your examinations. Thank you. Bye bye. And share this video with all the students who are appearing ACCA SBR, wherever you are connected. Okay, wherever you are connected, Instagram, LinkedIn, Reddit, or Telegram, wherever you are connected, share this video. Bye. Tada, bye bye, good night.